Yeah, I've got this morning, Will Danoff and Company have 15,603,241 headaches in analyzing Amazon forward. How do your people deal with the short-term emotion that John and I hear from Lisa Abramowitz every day? How do you deal with that?
It requires a lot of discipline, and it requires a long-term view. But it's interesting, you know. When I was a younger technician at Fidelity, and I would point to a risk of a 10% drop in the market. You know, someone with a very large fund with a long time horizon would tell me, well, that might be a problem for some, but for me, it's an opportunity to load up.
Okay, well, I don't want to get you in trouble with Ms. Johnson, but let's do it. Are you loading up on Amazon this morning?
No comment. I do not do individual stocks.
John, I thought we'd make some news there, but
I would not want to speak for my colleagues on that.
Okay.
That was a good effort, Tom. You're in Tim there, Fidelity
Nice
Investments.
try, Tom.
You're in. Great to catch up with you, buddy, as always. Bit of news out of Russia this morning. Let's go through the headlines. This is a country with inflation north of 15, 16% year over year. They just cut rates to 14%. The estimate was for rates to be at 15%. The Bank of Russia seeing room for the key rate to be reduced even further in 2022. And for those of you out there that might be pointing to the currency and suggesting that that's a decent measure of perhaps the pain the country's going through right now, the economy's going through right now, and perhaps suggesting not much, here's the outlook for growth. They see GDP in 2022 falling 8 to 10%. They had previously seen growth of 2 to 3%. Now, Tom, that is a monster revision from the Central Bank of Russia, and I imagine a lot of people out there believe it could be even lower.
And what's interesting, yes, exactly, John. What's interesting here is how you frame this word depression. There's a whole academic study, John, of what that really means, and I'm just going to say that a depression is a lot worse than we perceive. These are recession numbers, down 5%, down 7%. John, down 25%, down 30% gives you an indication of what the gloom crew is talking about in Russia. I'm not saying we're going to get there, but that's the scope and scale you need.
Lisa, this is the classic EM dilemma. Massive downside risk to growth, lots of upside risk to inflation. What do you do?
Basically, it looks like Vladimir Putin is taking a page out of Turkish President Erdogan's book, basically, by saying, look, we're going to cut rates when in doubt, even though no central bank has ever been successful in that way.
Big rate cut from the Russian central bank. From New York City this morning, good morning. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden has broad support in Congress for a massive $33 billion Ukraine aid package. Lawmakers could finish work on the measure by the week of May 9th. But if Democrats insist on attaching funding for coronavirus vaccinations and treatment to the package, action could be delayed indefinitely. Officials in China are defending the COVID-0 strategy as still the best way to fight the pandemic. They say the current outbreak is coming under control, with cases in Shanghai showing signs of turning around. The lockdowns have been criticized for exacting heavy social and economic costs. More UK companies expect to increase prices in the coming year to cope with rapidly rising inflation. Now, that's according to a survey by Lloyd's Banking Group. Almost 6 in 10 companies expected they'd have to raise prices, and more were reining in hiring plans. Barclays has suspended market-making activities in its own debt securities. The British bank is trying to fix a paperwork blunder that saw it mistakenly issue $15 billion worth of U.S. securities. Now, Barclays says the mistake shows a material weakness in relation to the internal control environment. And Amazon acknowledged that its hiring warehouse building binge during the pandemic is catching up with the company. The e-commerce giant says it lost money in the first quarter, and it forecasts that another loss in the possible current period as well. Revenue from the main online business fell 3%, a decline that was almost inevitable from the torrid pace during the pandemic. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
It is very clear in all of my discussions with folks in the European Commission that they are hard at work coming up with some sort of a cohesive package. That being said, Russia could begin turning off more countries before the EU begins to announce its actual energy package at this rate.
Dan Tannenbaum there, the sanctions expert over at Oliver Wyman from New York City this morning. Good morning. Futures are negative on the S&P, on the Nasdaq too by more than 1%. Disappointing outlook from both Amazon and Apple for the current quarter. Those two stocks suffering in early trading. Amazon much more so. Yields higher by 4 basis points to 86.37. Bit of data out a little bit later this morning. Euro dollar, stronger euro this morning. Going into a conversation with the chief economist of the ECB, Philip Lane, in about 30 minutes from now. Looking forward to that. One central bank that gets our attention right now, though, Russia. They cut rates from 17% to 14%. Mike McKee, probably one of the smartest guys I know in the newsroom, had this to say: European payments for energy making up the frozen forex reserves. Things are still bad, but it's a giant loophole that keeps Russia afloat. Mike goes on to say, Tom, that they can cut rates because there's no currency flight with capital controls. The rate rise was never about cooling demand for inflation, but holding money in the country.
It's exactly dead on, and goes to the discussion we had yesterday about the impossible trinity and the true trilemma. And when you have this word controls, whether it's yield curve control in Japan or what we've got in this crisis in Russia, John, controls matter. They have immediate effect.
Japan quiet going into the weekend. I think that's probably the best way of putting it, Tom.
Yeah, we saw that at a 128. Where are we now? My eyes are failing me. 130.10 on dollar yen. This is a joy to provide clarity on when you change the rules of what you do with a barrel of oil. Ellen Wald is definitive at the Atlantic Council as a senior fellow in her wonderful book, Saudi Ink, on the culture, the fabric of the royal family in Saudi Arabia. And today we're all embargo with Ellen Wald. Ellen, it's real simple. Can an embargo work on oil against Russia?
I don't think that in this case an embargo really can work on oil against Russia because there are, first of all, so many different points that Russia is able to export oil. We've got pipelines, we've got multiple ports. In fact, we've got ports and pipeline systems that they share with other countries like Kazakhstan, and that would be very, very hard to police. So I think that what we're really talking about here is Europe is kind of embargoing itself against Russian oil, and that oil will go to other sources. In fact, we just got news that Indian oil companies, Indian refineries, are looking to set and to secure some longish term contracts with Russia to import Russian oil. And there really isn't any way that, short of some kind of military embargo, that the EU and the United States can stop that from happening.
So then does Europe go after India?
Well, they can definitely exert pressure on India, but India is a huge country with an absolutely huge population that has no domestic oil production. So they have to import all of their oil. Their oil consumption is growing. Their population is growing. They're looking to really, to develop their country. And to do that, they need access to fossil fuels like oil. And they're not going to just bow down to what Europe wants because of some, conflict that Europe is in with Russia. We were able to get them on board with the embargo against Iran, with the Iran oil sanctions. But Russia is a whole nother ballgame.
Meanwhile, we're talking about the issues with Russian oil and perhaps a lack of willingness to dramatically ramp up production here in the U.S. We got Chevron earnings, we got Exxon earnings, and both are still underinvesting relative to where they were over the recent past. Exxon in particular, I'm looking at $3.4 billion charge-off for Russia. What do you think of that number?
Well, that's a pretty big number, and it's interesting to see how these companies are taking significant write-downs for getting out of their assets in Russia, and yet we're still seeing huge profits and huge earnings from these companies. And one would expect that we'd see a lot of that maybe reinvested into upstream or downstream development. But I think that we're seeing, instead of seeing that, we're seeing significant amounts of money being put towards share buybacks to lift the share price, which I think is something that long-term and long-time investors in these big oil companies have really been looking forward to, because they've been on such a downward trend for many years. And so now with high oil prices, they're looking forward to seeing their share prices go up. And one of the other issues with increasing oil production in the U.S. is really the bottlenecks, the supply chain issues, and the regulatory regime that's making it very difficult and costly to ramp up production in a hasty way.
Well, but Ellen, to that point, I mean, Exxon tripled their share buyback to $30 billion. They did not boost their dividend, although they are expected to later in the year. Ellen, how much does this make business sense for them? That frankly, it does not in their economic interest to boost production due to the boom and bust nature of the oil market? Or is this something where they just see it as no advantage because of some of the kinks in the supply chains now, but longer term would also make business sense?
I think that you can make an argument that it would be that they could increase their revenue if they did increase production, because increasing production is not going to bring oil prices down that much at this point, because in particular these other factors, geopolitical factors, are what's causing oil prices to rise. WTI is up at $106 a barrel just on news that Germany says it won't oppose an oil embargo, an EU oil embargo against Russia. And that's not something that any number of increase in barrels per day production from the U.S. can combat. So they definitely could make more money. But if you're looking at the long-term picture, then yes, it does make sense not to shell out a lot of money in a very hasty way to try to increase production that you might not really be able to because of all of these other factors. And instead, it does make sense to, say, pay down debt, to increase your dividend, to do these share buybacks. These companies will probably be in a very good position going forward. But from the perspective of the consumer, it certainly looks like they're taking advantage of the situation.
Ellen Wald of the Atlantic Council. Ellen, thank you. Of course, Lisa, they like to compare this quarter's profit to where they were, say, 2 years ago in 2020, and for good reason too.
Look, they have been doing amazingly well in terms of profitability, but Ellen Wald highlighted the real uncertainty here, which is from a business sense, it doesn't make sense for them to invest so much in production that's going to be perhaps hard to get out of the ground and that, frankly, might come at a very different price point in the future. And this is the tension with the political debate that we're going to hear throughout the day, throughout the weekend, and into the weeks ahead of the midterm.
I was just looking at the latest data from the Department of Energy, Tom, on crude output in America. It is kind of creeping higher, back to 11.9 million barrels a day. It's just not at the 13 that it was at going into the pandemic.
So I'm going to go to every single story we see. I'm going to say that Paul Sankey's really led on this in a heated statement. This time is different. They don't have the labor. They don't have the concrete. They don't have the pipeline. John, you know the story. I haven't seen a lessening of that. I'm sorry, I just haven't.
Big conversation in the next hour, Tom. Philip Lane coming up. Looking forward to that.
Absolutely. This is going to be an important conversation to set the tone for May.
Euro dollar 105.66. A stronger euro is a rare thing these days. Euro dollar is positive 0.6%. The chief economist of the ECB just around the corner in the next hour on this show.
nuestro estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
what we're seeing right now in the macro, we haven't seen in 30 or 40 years.
If you think about the broader macro environment, indeed, we have more challenges now.
If inflation remains stickier than we anticipate, it's possible the Fed has to be even more aggressive.
Our central bank is much tighter and much more willing to hike rates than anywhere else in the world.
It could get worse if the Fed moves as fast as it's telegraphing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures down 9/10 on the S&P, a little bit more on the NASDAQ 100, TK on Amazon, a whole lot more, down 9% in early trading.
John, it resets us into May. I mean, I thought the conversation was great between Jeff, you, and what we're going to do here on Amazon and Apple. It's just a reset of the uncertainty of April into May. I thought both companies said, look, we're still minting millions, gajillions, whatever, but, and the but was a big deal.
It's the but that matters. It's the outlook. It's the forward look that always matters, and it ticks every single box right now. Post-pandemic payback, supply chain issues, costs, and that's what Amazon is grappling with.
And the nitty-gritty here matters, but also the bigger picture. Joe Feldman over at Telsey marks down EBITDA and the enterprise value to EBITDA guesstimate. He brings his price target, and he still sees it going up some 20% or so on Amazon in the next 12 months. Or it can be macro, as we talk to Emily Rowland here in a moment about a pause for the Fed. When will that be?
Two-part story from Apple overnight, Lisa. The numbers came out, and I looked at them, and I thought, a $97 billion quarter on revenue, that's pretty decent. Throw in a $90 billion increase to the buyback, I think everybody will take that. You look for the line on China, it looked okay. And then came the explanation on China for the current quarter, different story.
Basically saying they're going to take a $4 to $8 billion charge on that and ratcheting back their expectations for the second quarter because of those supply chain disruptions that, and here's the kicker, they didn't even see any of the impact really in the first quarter earnings. So if you're looking for what the potential ramifications are, you're going to have to trust them that it's pretty bad and it's not reflected in the current numbers.
John, I will say beneath the radar, they made very clear iPad is really problematic because of parts. That was buried.
China's the issue, Tom, and hopefully we work through the China issue. Dan Ives of Wedbush, of course, longtime bull of the stock, believes we will work through the issue around Apple. This is what he had to say this morning, Lisa. It's not a reason to panic and sell the stock on a non-demand issue that ultimately will work this out in the quarters that matter, September, December.
But to your point, he says overall, our bullish view of Apple is unchanged. But it speaks to all of the concerns, as you've noted, John, right? And everything that people were worried about that would have a material impact on earnings are coming back to roost. And Amazon really represents not only the situations globally, but also how much people are paid. So facing all those headwinds, to have that extra hang up that Apple is facing with China feels a bit like a weight in a morning that's filled with concern.
Provides some oxygen for the story that Bramo's been pushing for a while.
Pushing or just worrying about looking
shining a light on, just helping people see it around the corner. Of course, that language, those words.
Around the corner.
Futures down 1% on the S&P. On the NASDAQ 100 down by 1.3%. Yields a bit higher by 3 basis points. The euro actually stronger today with a 105 handle at 105.65, up 0.6%. In about 10 minutes from now, call it 12, we'll catch up with the ECB chief economist. And crude, Lisa, 106. And let's just say the oil majors in America, they're doing okay.
We've already gotten earnings from Exxon as well as Chevron this morning. We're waiting Phillips 66 before the bell. How much do we get that political pushback within hours of these coming out? I mean, just to give you a sense, Exxon tripled their share buybacks to $30 billion. Chevron reported the best revenue, the best earnings going back a decade. How much does this really become an increasing political liability when, frankly, as Ellen Wald was saying, it doesn't make sense necessarily on a business level for them to increase output. Gas prices in the U.S. still near their record highs, so this is definitely crimping consumer spending or is expected to going forward. 7:15 a.m. We're all looking forward to ECB Chief Economist Philip Lane joining us here on Bloomberg Surveillance. This comes after a slew of data that came out of the Eurozone this morning, including inflation, the fastest pace going back decades at 7.5%, sort of shocking considering a region that's been fighting disinflation for so many years. And then, of course, also the kicker of the GDP coming out quarter over quarter of just 0.2%, basically basically petering out. This is the bad story that the ECB is facing, slowing growth and incredibly high inflation, and that's been really bleeding into the euro. How does he parse those together into a monetary policy that reflects the inflation rate at a time when real rates in Europe are beyond any historic precedent in terms of how low they are? And today we do get a slew of U.S. data. We're really focused. I will go through all of them, but honestly, the employment cost index is the one we're focused on. How much are we going to take a look going forward at the further momentum in employment costs at a time when the likes of Amazon, John, and we pointed to this, they're worried about all the people they hired because it is too expensive given what they are doing with the growth in their sales.
Lisa, thank you. Some headlines from China that we haven't touched on a great deal this morning. Bit of verbal intervention once again from Chinese policymakers suggesting they'll do what they need to do to support growth and maybe back off on the regulatory side as well. That's been a big, big issue for the tech sector in that equity market over the last 12, 18 months, maybe even longer than that. From Dow Jones, Tom, the reporting the following. China is seeking a pause on regulatory campaign against tech companies. They're meeting with tech giants, including Tencent. For a lot of people who have been pretty bruised by that trade, Tom, that might be some good news, if indeed they're still in it.
And in the slew, this is a stew of headlines, folks. We're going at this in real time as we do in surveillance. Beijing considering push for direct involvement in big tech companies. I think we need to make clear, John, this appears to be the Chinese companies, not direct involvement in Apple.
Yeah, I imagine it's not
we need to
the US companies, just to be clear about that, because
well,
the regulatory campaign has been against pretty much everyone in China. Lisa, I'd hope the aim is not to get involved in the US-based companies, and I'm sure the US-based companies hope that's the case too.
Yeah, because that probably wouldn't be a positive in the stimulative support that a lot of people are expecting in this particular push.
Joining us now, Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. Emily, put all the earnings together and let's talk about the month we've just had. This is the last trading day of the month of April. I almost forgot that. We're down by more than 9% on the NASDAQ 100, worst month since 2008. And many people asking the same question, when can I get back into those tech names? Emily, when?
Yeah, it's been quite a roller coaster ride. And John, we thought we were going to get to enjoy the sound of silence from the Fed during the blackout period this week. And of course, we've been on a roller coaster ride in terms of tech earnings. And we think really what's happening here is we're moving away from this period in which a rising tide lifted all boats. We no longer have ultra-accommodative Fed policy. We no longer have fiscal stimulus and speculative risk-taking. And now we're getting to see what the fundamentals actually look like for technology firms. And we're seeing a big divergence between some of the winners and the losers for right now. What we're watching right now is there has been indiscriminate selling across markets, and there's a few winners in there that deserve attention. We're particularly looking at the technology companies that exhibit those quality characteristics that we love. Great balance sheets, good return on equity, nice
come on,
earnings
Emily.
stability.
Emily, cut to the chase. Are you long Amazon this morning?
We have actually stayed away from consumer discretionary because there's a couple of big names in that sector that don't exhibit those quality characteristics. They don't have the cash on the balance sheet. We're a little bit more concerned about that. We're more overweight in traditional technology names, again, that are going to give us those great balance sheets and those organic growth drivers. You've got to have a great solid position in your industry to compete, again, as that macro tide comes away.
Is Amazon no longer a growth stock?
Yeah, well, you think about sort of what is the impetus, right? You look at the year-over-year comps, I think that's the biggest challenge for Amazon now coming out of the pandemic. I mean, we had 2 years of extraordinary demand for that business model, and now we need to see, what are those organic growth drivers going forward? And I think that's going to be a challenge.
Emily Rowland of John Hancock. Emily, great to catch up. What an earnings season it's been, Lisa. Just the numbers themselves have been pretty decent, pretty solid, but it's all about that outlook. And I think as we round out earnings season for the big tech names, that's exactly where we started the quarter. What's going to happen in the future? What's the outlook? Where's the guidance? And that's where we're finishing it, with the same concerns.
The fact that the NASDAQ was already down nearly 20% heading into the big tech week, it shows you how much pessimism was already baked in. And then to see the further declines in the shares after the earnings speaks to that pessimism and that uncertainty baked into the outlook. I think the bifurcation within big tech might be the story from this earnings season, John.
We've got to set up the conversation for the next few hours. On that bifurcation, I'm going to catch up with Dan Ives of Wedbush a little bit later. Lisa, that is exactly his angle right now. But for our next conversation with the ECB chief economist, Philip Lane, Tom, inflation at 7.5%. I have to say, in the Draghi years, did you ever think we'd get back to 7.5% on CPI in Europe?
And most importantly, John, Professor Lane never did. I really want to emphasize for our American audience, this is one of the giants of modern economics. This is must listen, must watch for global Wall Street.
Now, core CPI in Europe is much lower than core CPI in the United States, but this will be uncomfortable for the ECB because it's moving in the wrong direction still. So core CPI comes up to 3.5 from 2.9, and the estimate was 3.2. And what we're really interested now in the ECB is the sequencing. Winding down QE, and then what? How much space between that, which could end in July, and then that first thing that we haven't seen, Tom, since 2011, a rate hike from the ECB?
Yeah, well, okay, that's the process. And, you know, John, you're expert at that with your years in Frankfurt. I'm just looking at the core theory, which is it's a more sluggish, tepid run rate, a more sluggish nominal GDP. And that top line inflation there is absolutely unacceptable given compared to the United States, I should say.
I think the way we frame it, Lisa, is a rock and a hard place for central bank officials in Europe at the moment.
You've characterized it as the emerging market dilemma, except that the European Union is experiencing that. How do you hike into a weakening economy? I was looking at some of the components of the inflation print that came out of Europe this morning. 38% increase in oil and gas. This is an energy-fueled kind of inflation, and that is the worst kind, because what that means is it crimps the consumer, and that is the dilemma that this ECB is facing.
The ECB chief economist, Philip Lane, is going to be joining us in just about 5 minutes' time from New York City.
Is facing.
The ECB chief economist, Philip Lane, is going to be joining us in just about 5 minutes' time from New York City this morning. Good morning with Tom Keene, Lisa Abramovich and Jonathan Ferro. Futures are down 0.9% on the S&P. On the Nasdaq 100, we are down by 1.23%. And Amazon is trading lower in early trading by around about 9 full percentage points. Heard on radio, seen on TV, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. China's Communist Party leadership has ignited a market rally. The Politburo promised to boost economic stimulus and spur growth and to contain the country's worst COVID outbreak since 2020. Now, a statement has said that authorities should keep the economy running within a reasonable range. It also promises to guarantee supply chains in key sectors. Inflation in the euro area has climbed to an all-time high. Consumer prices rose 7.5% in April from a year ago. That was in line with estimates. The new numbers will raise pressure on the European Central Bank to end the crisis-era stimulus and raise interest rates. Federal Reserve Chair Jerome Powell is likely to slow the pace of rate hikes after front-loading in the next 2 months. That's according to economists surveyed by Bloomberg. They expect the Fed to raise rates a half percentage point next week and again in June. Then the economists say the central bank will downshift to a series of a quarter-point increases. Russian forces have pounded targets from one end of Ukraine to the other. That included Kyiv, which was attacked while the head of the United Nations was visiting. It's the boldest attack on the capital since Russian troops retreated several weeks ago. Chevron posted the highest quarterly earnings in almost a decade. Soaring demand for energy and Russia's invasion of Ukraine strained supplies. Now, that led to higher prices for everything from natural gas to diesel. And meanwhile, Exxon posted earnings that missed estimates. The company took a $3.4 billion charge related to its Russian operations. Still, Exxon will boost its share buyback program to as much as $30 billion throughout next year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Everyone you meet in Port Harcourt has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City on TV and radio, this is Bloomberg Surveillance. Futures just a little bit softer on the S&P by 0.9%. Something we haven't seen for a while, TK. A euro that's stronger by 0.5%. Euro dollar 105.61.
A little bit of a lift there in the euro this morning in this time of huge tumult within foreign exchange and all of the uncertainties we face into the month of May and indeed into 2023. John will address the ECB here. I will introduce Philip Lane. He is the chief economist at the ECB, and I want to make clear, particularly to our American audience, there is no equivalent at the Fed. With the inaugural chief economist, Amartya Singh of Germany, this is considered a key position in global economics. Philip Lane, I want to go back to a paper you did from Trinity over to Harvard years ago with a guy named Mankiw. And you and Greg Mankiw did a paper on economics and the scientists and engineering of it all. Do we throw the textbooks out now? Does the science and does the engineering of modern economics work given this moment?
So I'm familiar with that paper, but I cannot take credit. I think it might have been Greg Mankiw and maybe Ricardo Rees at the London School of Economics. But the basic question is still very relevant. And absolutely, in central banking, it's a blend of course, respecting the science of the textbook, while also understanding we live in a real world where we have to, understand the actual data arriving and to filter out and come up with policies that work in the real world, not just in the textbook version.
Well, let's talk about the real world and the data this morning. Philip, great to have you with us on the programme, sir, by the way. The rising core inflation in the Eurozone, more bad news, comes in at 3.5%. I want to start with how worried you are about the second round effects here and how quickly you think we should react to that pressure.
So clearly the whole economy, all sectors, so core, non-core, the whole economy has to adjust to essentially three factors in Europe. One is the very large increase in energy prices, which of course matters directly, but also matters indirectly because every sector uses energy. So every business which uses energy as an input, including in the services sector, just think about hotels, restaurants, transportation, that energy shock will show up everywhere. A second factor is the pandemic, and that's working through different channels. As you know now, with the renewed wave of lockdowns in China, we have new bottlenecks. We also in Europe have the reopening of the economy this winter, including the early weeks of Q1, which we've just seen. A lot of sectors were still locked down, which basically meant that there was a lack of activity, and also, honestly, in a world where less pricing pressure. And then as we reopen those sectors are also going to normalize prices. And then the third element is the war. And the war, when we're talking about, it started, as you know, in late February. And this is a source of great uncertainty for the European economy. Of course, it interacts with the energy shock. It interacts with bottlenecks, but it also has a direct effect in terms of anyone trying to kind of form their outlook for Europe for the coming months and years. How the war plays out in the coming weeks and months is really the most important topic.
Well, let's talk about how that informs your sequencing. The latest minutes published by the ECB, let's call them the accounts the way you like us to, showed you viewed the call for a rate hike sometime after the end of asset purchases. I understand from your point of view, you want to disentangle the rate hikes from asset purchases. I get all of that. You've suggested recently, Philip, that would give the Governing Council this extra space. Do you think you still need that extra space, given everything you've just said and given the data this morning?
So I suppose, let me be clear along a few dimensions of that. The idea is to have an option. So that option is an option that could be invoked quickly. As President Lagarde has said, I think in the press conferences, it covers a range at the long end from a few months to the short end, even a week. I think she mentioned that at the short end. So it's an option. It's not a fixed window of time. And essentially, here we are at the end of April. We're nearly 6 weeks. 6 weeks, I think, from yesterday to the June meeting. And after that, we have another number of weeks to the next meeting in July, and so on. So I appreciate those who are trying to form market judgments like predictions. I'm much more focused on the process. We need to take into account the data we've seen today. Yeah. We need to take into account the both on GDP and on inflation. We're basically, honestly, in the middle of the staff are working on the projections that will inform the June meeting, and we've a clear sequencing in terms of policy making, but also in terms of the meetings we have and the information we have. So I don't really want to run ahead of that sequence.
Philip, you mentioned market pricing. Do you think it adequately reflects right now the way you're communicating? Is that of any interest to you whatsoever?
So, I mean, I think those involved in the market and policymakers are essentially confronted with a number of factors. Number one, I think you said earlier on in the commentary, our current policies, our interest rate policies, were developed at a time when the imperative was to try and tackle inflation that was persistently below our 2% target. So we've been basically saying all year long that on a step-by-step basis and conditional on this outlook where we do think we are not returning to that low inflation trap of normalizing interest rate policy. So the interest rate policy will move. The question of interest to everyone is exactly when that will start. And we essentially have been assessing in our recent meetings that we should be data dependent to respect the uncertainty we face. And we
Philip,
know,
with all due respect, can I just jump in, sir? I often hear this from central bankers that you'll be data dependent, and then I see the data change, and then I don't see anything you say that changes whatsoever. I mean, I asked a question earlier on about what you said about a month ago relative to what the data says now about whether you still need that extra space between ending rate purchases and rate hikes, and then you say we're data dependent still. Sure, jump back in.
let me challenge this. Just look at the very large changes in the ECB's monetary stance since December. So in December, we took decisions which were not universally praised at the time to have a big scaling down of asset purchases, including through the announced end of the PEP purchases at the end of March. So in terms of step one, scaling down the monthly volume of purchases, a lot has already happened. Step two of not only ending the PEP, but talking about concluding net purchases under the APP. We've signaled a strong expectation that this is coming up. And then after that sequence, it's the issue about moving interest rates. And the market and for ourselves, the story is not the issue about are we going to move away from minus 0.5 for the deposit rate. The big issue, which we do have to still be data dependent about, is the scale and the timing of interest rate normalization. And we've just talked about the high uncertainty. It's recurrent everywhere that there are mixed dynamics in the euro area. In the near term, yes, inflation is very high, and that does carry its own risk of momentum. On the other hand, the high energy prices are eating into disposable incomes. It's reducing consumption. The war, has the scope, especially depending on how it goes, in terms of mapping into lower investment, lower consumption, through confidence effects, and extra pressure on energy. So I'm going to hold to this perspective that a lot remains data dependent. But I would emphasize though is we're I don't think you're hearing anyone saying that the current deposit rate of minus 0.5 is going to be remain there indefinitely. It's all about the prudent and robust and durable way of having normalization.
Looking at the move in the euro, it's been pretty brutal over the last month, Philip. Euro dollar's down about 4.5% on the month so far. You will, of course, tell me that this is not a policy target, but we can all agree it has possible implications for the medium-term outlook for price stability. With that in mind, Philip, are the latest developments problematic for you?
The way, I would think about it, I think I've always taken this view, is that the exchange rate is a very important macroeconomic variable for Europe. The euro area is a big trading bloc. It's from a macro point of view, the exchange rate absolutely matters. So when the staff now are working through the projections for June, that currency depreciation will be an important factor shaping the projections. And again, to emphasize, one channel is the mechanical effect on import prices. But when we think about investment, when we think about consumption, net exports for the euro area, it's a big macro variable. And this move is significant. So anyone looking at that and trying to think about the implications for monetary policy, that will definitely be one trend, along with every other trend that we need to think about, which will be integrated into an overall assessment in the June forecasts.
Philip, how much does it affect your expectation for the potential for a recession in the euro region? And I say this as ECB member Mattis Muller came out and said that they saw that the chance of a recession in the euro region was low. Do you agree?
So absolutely in our baseline, let me point out two factors. One, there's still a lot of momentum from the recovery from the pandemic. That's true, especially when you think about year on year, because this time last year, there was, we were still very far below the 2019 level. Now, so, when we think about the economy, that momentum is there. But it's not just about that kind of base effect. The momentum, we've just seen, a positive Q1, not very high, admittedly, but still positive. And we know from the near-time indicators from what's going on right now that there still seems to be reasonable activity right now here at the end of April. Again, I don't think it's the most interesting way to kind of frame the question, because even if the economy continues to grow, compared to the pre-war baseline, under all scenarios, the path for output is not going to be as high as we were hoping before the war broke out. So the basic analysis applies regardless of whether everything ends up being so strong to put us into negative territory. But really, it's not so much about what we know today. We all know the possible scenarios. We all know the possible scenarios about the intensification of the interruption of energy supplies and other scenarios and this is why at the ECB we've been publishing scenarios.
Yeah.
We've been emphasizing we don't just look at the baseline, but also adverse and severe scenarios.
Philip, just to sort of sum up, though, are you saying that the market is wrong because the market seems to increasingly be pricing in a recession in the Euro region and pricing in that those scenarios look a lot more likely? Are you saying that the risk reward is perhaps a little less pessimistic from your perspective?
No, I don't think, again, I want to spend any time on commenting on that. What's true is the market, of course, has to fold in a significant risk premium on inflation, a risk premium on GDP. And there is a covariance factor there, which is basically the urge to kind of look for protection is going to be higher when you're confronted with the risk of higher inflation and lower output. And so filtering out between risk premia and what the market truly expects. Of course, we did that ourselves in understanding the data. But both forces, risk management and kind of true forecasts, are obviously influencing market pricing.
Philip Lane of the ECB, the chief economist. Philip, fantastic to catch up with you, sir. Deeply thoughtful stuff on a tricky moment for this European Central Bank. Philip, thank you. TK, let's talk about it. Ultimately, inflation's still moving in the wrong direction for European policymakers, and the balance sheet has been expanding even if they are winding down QE. And that space between winding down QE and raising interest rates is the focus for this market.
I think their model is so original, and their structure, as Philip Lane is expert in, is so original, John. They don't have a trilemma like Japan. Dr. Lane and Christine Lagarde have 19 trilemma they have to deal with. There are 19 different stories, and the heart of the matter, John, is 7% inflation in Germany, the same as 7% inflation in Portugal. And I don't envy, all this technical nuance is completely secondary to them avoiding a Trichet, avoiding Bank of Japan, and I think it was 2004, and it's going to be, as I think he alluded to, exceptionally delicate, and they have to keep their optionality open.
The euro right now 105.64. If you're just tuning in on TV and radio, just catching up with the ECB chief economist on the next policy steps, given what's happened with Eurozone CPI this morning, pushing higher through 7%. Futures stateside, negative 0.9% on the S&P. On the Nasdaq 100, down about 1.25%. The big conversation, of course, is about big tech. Let's get you some single names, some movers. We can do that with Kriti Gupta. Morning, Kriti.
Yeah, good morning, John. You were mentioning the big tech story. A lot of this is really stemming here from what you're going to see in Apple, from Amazon. It's that growth story. Apple in particular warning about the supply chain issues. $8 billion of potential losses coming out of China. And that's really the issue here, because Tim Cook, of course, has built his legacy on securing that supply chain. So not great news for Apple, down 2.3%. A different story for Amazon, although you could argue that it's almost similar in that they've invested so much in their labor, in their warehouses, that sometimes when you see that slowing growth narrative, once again, that slowing spending narrative, the margins just aren't there. And that, of course, is what's sinking Amazon stocks over 9% this morning. And when we're talking about that slowing down of the consumer, spending is also tracking into the Intel story as well, forecasting lower PC demand, weighing on those shares to a tune of 3.7%. But those are not the only tech heavyweights we got to keep our eye on. Tesla is another one this morning, actually up, in contrast to some of the other moves you're seeing in tech, up 1.7% after Elon Musk has disclosed that he's already sold $4 billion. We've talked over and over and over again about how that Twitter deal is going to get funded. Do you sell Tesla to buy Twitter? And that was really the trade that seemed to be happening. Twitter shares up, Tesla down. Today, a little bit of a sigh of relief that share or that selling already in the rearview camera. ExxonMobil, Chevron are also the oil companies you want to keep an eye on. Both reporting earnings this morning. Both record profits for going back to over a decade. But why are they down when oil prices are up? A lot of this has to once again come down to the growth narrative. You're starting to see a slowdown in record profits from big tech. How long do you see a slowdown in the oil space as well?
Pretty good. Thank you so much. Greatly appreciate it this morning. To follow on from Professor Lane, we speak with Professor Wiseman. Terry Wiseman is a perfect follow-on to the giant from Trinity College with his international economics and his understanding of the history of what we've lived in April, going from Fleming and Mundell through the giant Rudy Dornbush of MIT and on to Wiseman at Bear Stearns and now at Macquarie. Terry, what a fascinating time as Philip Lane tiptoed around that. And it's about trilemmas. Let's start with this word control. Are we going to get ourselves into bigger problems if we have visible controls like the experiment in Japan or less visible controls like the experiment in Europe?
So one thing I do agree with Dr. Lane is that it is a delicate time for the ECB. But I am of the view that there is a clear path forward, even when inflation is driven by supply shocks. There is a great risk that there will be secondary effects on core inflation, and that there will also be secondary effects on inflation expectations. I think that the data in Europe this morning is clear in that respect. Christine Lagarde had said back in February and March that the preponderance of inflation in Europe was energy driven, and yet we're getting numbers this morning that seem to belie that view. I really don't think there's a dilemma here. I think the path is clear. They should be raising rates, moving towards normalization of the balance sheet. I think the market right now is pricing about 3 interest rate hikes from the ECB, and I think that's about, at the very least, the right direction, the right magnitude that we're going to see come out. I don't think there's a dilemma here. I think the path is pretty clear.
So if the ECB does raise rates 3 times, Terry, this year, does that make the euro stronger or weaker versus the dollar at a time when that's likely going to slow growth that's already slowing?
Yeah, it's good. Well, economists like to say ceteris paribus, all else equal. All else equal, yes, especially when you consider that inflation in the U.S. might be topping out in the next few months, especially when you consider that the sanctions on Russian energy are probably going to drive European inflation higher and European expectations higher. And drive the sentiment at the ECB to be more hawkish relative to the rhetoric that's going to come out of the Fed, which I think has reached maximum hawkishness in respect of at least of the rhetoric. Yeah, yes, it will drive the euro higher. However, and this is a however with a capital H, there are a lot of events over the next few weeks that could derail the euro once again. And I would point most significantly to all the things that President Vladimir Putin has planned for the war between now and Russia's Victory Day on May 9th. I think we're entering into a period of maximum risk for the euro in that respect, not minimum risk.
Meanwhile, the dollar was really also the story yesterday, rising to the highest levels going back to 2002. Was that basically capitulation? Was that the recent peak for the foreseeable future? Do you think that that really is going to be the haven trade that is persistent over the next few months?
So the dollar's been strong against the other majors, but not necessarily for the same reason across the majors. And that's why it's kind of difficult to make a very broad breadth umbrella statement about what the dollar is going to do. So, for example, in the case of the Chinese yuan, the dollar has stayed strong and gotten much stronger in the last 2 weeks, in part because the market has capitulated to the view that China is going to be slowing because of COVID and that that's an intractable problem. But that's different from why the dollar has risen relative to the yen in Japan. That has more to do with the increasing yield spreads between the U.S. and Japan, which are primarily driven by the BOJ's reluctance to move towards more hawkish policy, as we've seen with the last meeting. I think in the case of the euro, it has very little to do with monetary policy. The fact the dollar has been strong has much more to do with the risks emanating from the war, and specifically the growth risks, which weeks is what the market has focused on, as opposed to what the ECB is going to do with regard to inflation. So right now, it's actually very difficult because the dollar is, yes, strengthening in a perfect storm, but a perfect storm that has coalesced a few mini storms around the world. And yes, you could see one or two of them dissipate, but that doesn't mean that they're all going to dissipate. It's very possible the dollar stays strong against the euro because of the war, but it starts to stabilize with regard to the yen because the BOJ has a change of heart, let's say, by the time of the next meeting because Japanese inflation starts to rise.
Terry, awesome, as always, buddy. Terry Wiseman there of Macquarie on the latest. The challenges for the BOJ, Tom, the challenges for the ECB, and next week, the challenges for this Federal Reserve.
Well, the Federal Reserve is going to be radically different. I think for our American audience, obviously focused on the original meeting we're going to see May 4th. John, can we just assume it's a 50-beat move? I think we can do that,
At this point, I think we can.
Yeah. And there'll be some history, we'll talk about Arthur Burns and trot out Greenspan and measured and that, but it's a walk in the park compared to the way you saw Professor Lane walk around the niceties that he and Christine Lagarde have to deal with. I would assume with data coming on, as he said, they're data dependent, that to be direct, the Germans are going to be apoplectic over the duration of 7% inflation.
Their projections are going to be interesting. And he mentioned that, given the weaker euro. And we get those projections, we wind down QE in Q3, and then what? And how quickly
How do you do an x-axis with a major war going on? I don't get it.
Well, what do they do, Tom? Do they wait? Because at some point, it was a very expensive way of saying that some of this stuff is transitory. Maybe it's not. Do they wait? Do they have the?
They will be data
they have the
dependent.
luxury of waiting?
What if we go to 8% inflation?
TK,
then
you
they're
keep
further
saying they'll be
data.
data dependent. Look at where inflation is and where it was. What have they done with policy? Is it tighter or looser?
They were transitory.
Come on. Futures down 1% on the S&P, on the Nasdaq down 1.4. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. President Biden has broad support in Congress for a massive $33 billion Ukraine aid package. Lawmakers could finish work on the measure by the week of May 9th. But if Democrats insist on attaching funding for coronavirus vaccinations and the treatment package, action could be delayed indefinitely. Officials in China are defending the COVID-0 strategy as still the best way to fight the pandemic. They say the current outbreak is coming under control, with cases in Shanghai showing signs of turning around. The lockdowns have been criticized for exacting heavy social and economic costs. Law enforcement authorities are searching Deutsche Bank's Frankfurt headquarters in potential money laundering case. The prosecutor's office says the rapid delays to reports made by the bank. Now, Deutsche Bank is said to be cooperating. Elon Musk sold about $4 billion worth of Tesla stock after clinching the deal to buy Twitter. Analysts and investors had suspected that Musk might need to sell some stock to cover the $21 billion equity portion of the deal that he personally guaranteed. Now, meanwhile, in Musk's pitch to bankers before the Twitter deal was done, he mentioned job cuts and ways to boost cash flow. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
Exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
We said that in this year of 2022, we expect supply to improve dramatically. That it is true. We said that the second half will have significant improvements in supply. That is happening. But having said that, we still have more demand than supply. We are now not demand constraint, we're supply constraint.
It's been the issue of the last 18 months or so. That was Cristiano Amon, the Qualcomm CEO from New York City. Good morning to you. Futures negative on the S&P, on the Nasdaq too. On the Nasdaq down by 1.36. On the S&P we're down by 1 full percentage point. Amazon is down by 9.7%. If you work through the release from Amazon yesterday after hours, the CEO Andy Jassy said this: we're no longer chasing physical or staffing capacity, Tom. Our teams are squarely focused on improving productivity and cost efficiencies throughout our fulfillment network.
Yeah, and that is absolutely, John, the key single sentence off of what we heard yesterday. Let's dive into this right now. We're not going to do price target. We're not going to do buy, hold, sell. We're going to talk to Brent Thill. And what you need to know is it was major global Wall Street headlines the day he launched from UBS over to Jefferies, and Mr. Thill joins us this morning. Brent, I want to talk about Silicon Valley arrogance. You are really, really good at this. How do you feel about the Bezos-Jassy feeling that we're only in this for our consumers, we're not going to harm our consumers, the inflation is something we're going to deal with separate? Are they forgetting their shareholders because they're thinking only of the consumers and they need to input inflation-fighting price increases right now?
I think they protected us in the pandemic. I mean, if you think about what happened, you know, they went from 20% growth to 40% growth overnight, and you can't automate a delivery of toothpaste via a drone and some software.
Right.
And so they had to build this capacity out, and then all of a sudden we're back to normal. We're starting to go back from clicks, you know, into bricks, right? We're wandering into Target and Walmarts and in convenience stores on our local blocks to pick up goods. We're walking back into you know, physical stores. The world's returning to normal, and they can't just automatically snap their fingers and go back to normal.
So
it's going to take time to unwind this, and they've said they have overcapacity now, and it takes time.
So I want to buy, hold, or sell into 1 year out, or 2 years out, or 3 years out. Did you find a confidence on the call yesterday that they can manage out from this pandemic to a good outcome of growth on the income statement?
Well, I think they've been great, sources of value for shareholders over time. So I think the answer right now for tech is all of tech's in the penalty box. We're seeing a massive downswing post-pandemic hangover. Multiples have come from living with the aliens, as we call it, back to planet Earth. And we have a potential recession that we're all staring at in the next year. So right now, every asset class is under duress. And I think it's not only Amazon, it's the rest of tech. And so I think that over a 1 to 2 year period, the answer is yes, it's a great investment. If you start to look at now the recurring software and ad business, these two businesses could potentially account for Amazon's entire market cap on this pullback. When you look at a few years out and start to put some multiples on the sum of the parts, and Amazon's AWS business is only getting stronger. So I think you have to separate the business between the software and ad business and the retail business. The retail business is in a tailspin in the short term, with a decline in actual demand, as well as costs that they're having to get a hold of. So yeah, price increases have to come in, but again, this just takes some time on the retail side. I think most of our investors are looking at that, are looking at the other part of the business and some of the parts, and really looking at the AWS and ad business.
Brent, I'm looking right now at your price target of 3,700, and you've got a buy rating on Amazon. Shares currently $28.91. What do you think, or that was where they were at the close yesterday? They're down a lot lower than that now in pre-market trading. What makes you think that they can get to that 3,700? Is this entirely a bet on AWS stripping out the entire commerce business?
Well, there's a sum of the parts when you take effectively the 6 big parts of the business and you strip them down and look at what multiple do you pay. If Amazon was a standalone company, if you look at 2023, this company's going to do, the division of AWS is going to do $100 million in revenue plus. And most investors would pay, 8 to 9 times forward revenue. That in itself is worth $900 billion just for that business. So you take the decline in the stock, you start to add the ad business, you add part of the media business, and you subtract the retail business, and investors aren't paying the big multiple.
Okay, this is critical. You've mentioned this twice now, Brent. We're going to end the interview here, and I need to get this in. It's too important. Are you telling me in an acquisition of Amazon shares this morning that I'm getting a cardboard box business for nothing?
You're not getting it for nothing, but you're getting it for a multiple, depending where it opens, and really not a huge multiple. And you're getting a free call option over time that can come back and stabilize. So I think, again, you have to look at it from the sum of the parts, not from just the retail business. And I think that's what everyone's doing. So we're trying to think of it a little more thoughtfully over a period of time. And I'm telling you, when you have 60% market share of the big 3 in the cloud against Microsoft and Google, I'm not worried about their high sources of profitability. This is a 30 to 40% margin business over time that no company is going to leave once they go to on AWS.
Brent,
so
just
that gives you
quickly,
conviction.
I wanted to squeeze this in if I may. Your view seems to be the view on a south side right now. 57 buys, 1 hold, 1 sell. The market seems to be interpreting things differently. When you have the conversations with the buy side and you talk about what's happening with this name, what's the pushback you're getting, Brent?
Pushback right now is no one wants to buy anything in tech. So it's not just Amazon. Go pull up a chart on Microsoft. Go pull up a chart on Google. Pull up a chart on anything. We are in a buyer's strike across Wall Street on software.
Brent Thill, awesome to catch up, of Jefferies. That is the buy strike right now, Tom. And the view, I think, from Dan Ives and Brent is that when things move away from this situation, as they inevitably do,
right,
that you start to get this bifurcation. in tech again, and we don't treat all names the same way.
That was an exceptionally important interview, and I'll feature that on Monday as well. John, I'm going to be as direct as I can. Tech animals hate to do some of the parts analysis. What's the value of cloud? What's the value of the new advertising business? What's the value of the cardboard boxes? Because there's so much growth dynamics involved. But you just heard Mr. Thill there talk of some of the parts analysis on Amazon that was frankly mesmerizing.
Well, I think he said 900 billion for AWS, Tom.
Yeah.
So coming into today, we're at 1.4 trillion. Going to take about 10% off of that. And that's the point he's trying to make, that you're not trading at a high multiple for the other side of the business.
Yeah, I mean, I just think some of the parts, and Ives will skirt around this as well within his optimism.
Looking forward to catching up with Dan a little bit later. Futures on the S&P are down about 1%, on the NASDAQ 1.4%. One team, one Bloomberg, Tom, same company.
Geez. Thank you very little for that.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccines specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
This is a new macro regime. And the risk premium, I think, has to go up everywhere when you're seeing these type of moves.
We just don't see a soft landing as the most likely outcome.
I don't think this can go on forever with food inflation and gas inflation where it is.
This monetary policy divergence is really, to me, the driving force.
The dollar has been the key. That's where people hide when things go wrong.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A most eventful Friday. We get set for May. John Farrow, we've got to say it for the first time, 4, 5, 6 days until that Fed meeting.
Yep, Tom, 1 week away. Looking forward to it. And we're all expecting a 50 basis point move from the Federal Reserve. And then what? Maybe another 50? What happens after summer? And what happens when we get to what they think is neutral? Yeah. Tom, that debate is still wide open.
And I really didn't get to it with one of our guests this morning, but John, you and I are going to do it right now. How hard do we focus now on July 27, September 21, or dare I say November 2nd? We've got to look out there. By November 2nd, John, sterling's going to be at parity.
Yeah, I have no idea where we'll be at the end of the year, and neither does this equity market. So, Tom, when the numbers come out from Apple, from Amazon, and from Apple in particular, the numbers look decent. And then we started to get this sort of fluffy guide about what might happen in Q3 for them and Q2 for us. Not great, Tom, not great. And that's the issue at the moment.
CFA analysis, fluffy guide. Lisa, help us out here. The fluffy guide is mostly the mystery of China.
Well, the fluffy guide is broad-based and very significant in terms of worry. Just to give you some perspective, when you talk about looking out into the future, there were 200 mentions of recession so far in earnings calls. That's a 180% increase on the previous quarter, even though you're talking about sustained momentum right now in the consumer.
I mean, it's important, John. Let's go back to May 4, John, because I think it's so important. The press conference, big deal. Let's assume it's 50 basis points in that. Chairman Powell can't do the fluffy guide in that press conference. He's got to give some wisdom.
I think he's going to try, Tom. I think he's going to try. Citi and most of Wall Street, actually, are on board with this idea that we get another 50 basis point hike after that. What we will get, though, as we get deeper into summer, are a series of year-over-year inflation prints that should be decelerating. Then you start to get this mechanical peak in inflation, and I just wonder how they internalize that, how they respond to it. And the ultimate question for all of us is whether they are willing to accept a more prolonged period of above-target inflation. Is 3 the new 2? Is it 4? They're not going to tell you that, Tom, because they're committed to what it says in their mandate, but how they behave will be suggestive of what they're willing to tolerate through the rest of this year.
Philip Lane did not want to go there in the last hour, the chief economist for the ECB, and we're going to dive into this with Katrina Dudley in a moment. But, John, I'm sorry, this idea of central bankers accepting 3.00% and Adam Posen inflation metric.
I know.
I'm not there yet, John.
I'm going to say this on the ECB relative to the Fed.
Please.
The ECB right now has got a tougher job than the Federal Reserve.
120 oil. 120 oil is a whole different world. We're at a 109.35. That's Brent crude. That's slipped up on us this week.
Watch the second round effects. Watch the salary negotiations in places like Germany. Watch what happens. It's easy to say from a policy perspective that you can strip out crude, strip out energy, strip out food.
Right.
When you get the wage negotiations, Tom, and they start to go to 6, 7, 8% over a series of years, that's how this becomes embedded.
I'm going to do the real yield right now because you'll see that program this afternoon and through the weekend with Jonathan Farrow. 10-year real yield negative 0.14%. I guess it's sort of in betweeny, John, isn't it?
Futures down about 1%, Tom, on the NASDAQ and on the S&P 500. Something in between where we have been going into the Fed next week. Euro dollar doing something it hasn't done in about a week. Euro dollar 105.47. We have a stronger euro, TK, off the back of inflation in the Eurozone at about 7.5%.
We do. Right now, joining us in studio, Katrina Dudley, portfolio manager and research analyst at Franklin Mutual, far more importantly, at Federated years ago with a technology shingle out across her desk. We're thrilled she could join us at our headquarters today. Wonderful to have you here. How do you take the technology boom that you were expert on at Federated and fold that over into macro strategy right now?
I think we were just talking before about the fact that, you know, the valuation of technology companies has gone at looking at the sustainability of the cash flows, looking at the business models, and now to some of the parts on Amazon. I mean, you just heard back from Brent about, you know, taking AWS and valuing that at almost $1 trillion company, and then we're getting these, you know, some of these parts for free. And I think Amazon is just such a great micronism of what is happening in the global economy in terms of the cost pressures, the need to serve the customer and the consumer.
Our viewers and listeners are buffeted this end of April with war, 2 once-in-a-lifetime events, a pandemic, and now this huge war in Ukraine, which, folks, full disclosure, the reports we have from Bloomberg and Maria today was really, really challenging this Friday. Great. How do we use your macro strategy to maintain confidence to participate in the markets?
I think that you need to think about the market as being like an escalator. There are bumps along the way, but it is going up over time. And it is one of the best protections against inflation.
Right.
So from that perspective, I think just to the person on the street, that averaging down, taking advantage of these opportunities just makes so much sense.
Lisa, this is so important. Katrina's never taken the escalator you took as a kid at Macy's. The wooden escalator there was a threat to society. I thought I'd die on that puppy.
Don't they still have it?
I think they may still have it,
they
but
still have the.
Katrina's never enjoyed the wooden escalator at Macy's, which is a threat to children.
Well, it raises a question because a lot of people are going on the down escalator, and that fear, that buyer strike that we were just hearing about in tech, it seems to be somewhat pervasive. And I wonder, Katrina, when you look at balance right now, how you balance out that downside risk at a time when bonds and stocks have been selling off in tandem and may very well continue to do so.
I think in terms of balancing risk, you make a good point. But the fact is that if you look over time, the equity markets are the place where you can cover your inflation. So if you think about it, what's the covering inflation mechanism? It's pricing. And from our perspective, when we're looking at these pricing conversations, we're going back to fundamentals. And we're saying, you know, what is the pricing power of this franchise? Because pricing is a balance, and we're starting to see those conversations because you need to put in enough pricing to cover your higher costs, but you can't put too much through because you're going to start to see demand destruction, or as we heard yesterday from McDonald's, you'll start to see the trading down into lower priced products. So there's a balance that's going on in corporate America that needs to continue. I think, you know, there's just so many different companies and franchises out there that we like that are strong. And I think that if you are a stock picker, I think this is the time when stock picking really starts to shine. So sometimes you need to take off that macro hat and you need to really dig in the weeds and look for names that really make sense with that pricing ability and that pricing umbrella.
How much pricing power, Katrina, does big oil have?
They're a commoditized market, so they have absolutely none. At the moment, it is like, you know, 1999 for them. You know, everyone's partying, everything's doing just great, and no one's talking about taking away, I think, that proverbial punch bowl as we talk about it. But if you take a look at it, the companies are actually being extraordinarily shareholder friendly. You know, they're talking about, instead of taking this excess returns and going out and exploring more for more oil, they're actually returning that to shareholders. So I think that we've really had a regime change here, and that regime change is really good for shareholders.
This is great. This guy from Perth, Australia emails in, Katrina. He says, she's Australian, isn't she? You know, I think, you know, he sort of got the accent, but his name is Qantas. He's a little slow. Every parent watching this has a kid where we're going, just shut up and go to Bond University. Tell us about your Bond University in Australia, which is one of the great, great academic successes of the last 30, 40 years.
It is. It's actually Australia's first real venture into private universities. So most of our universities over there are public, and Bond was established by Alan Bond. It was a great experience, and the reason I did it was a fast-tracked experience. So I was able to, we do 3 semesters a year.
But it really worked out. I mean, this rich guy said, let's build a school, let's do it Ivy League-like.
Yep.
And am I right that it actually worked out?
It definitely did, because having those 3 semesters gives people flexibility to be able to take a semester off without disrupting their entire academic career. And when you can do that, what that means is you can go and do those internships and go.
No, it doesn't mean, come on, Katrina. John, what this means is you can go out with the Veronicas on tour.
CK, you're missing the punchline. Katrina, tell this audience how long it took you to do a degree, a bachelor's commerce degree.
You're right. I got my law degree and my commerce degree in 3 years.
Okay, for
John,
John, pick this up because this is a third rail with you.
The 4-year degree in the United States of America is a total waste of money. A total waste of money.
Okay, so
Cut it off, reduce it to 3 years.
I teach at Rock the Street, Wall Street, and we actually teach young girls about how to evaluate the cost of a college education here in the United States.
Awesome.
We have them, we get them to look at salary data for the jobs that they want, and then we have them evaluate different options.
Let's get you two on the same page. From England, from Australia, you look at the American education machine as one big scam.
I think Jonathan's looking at it as a big scam.
Katrina's not saying that. What I'm suggesting, Tom, is that you can see how they could reduce 4 years down to 3 quite easily in the United States and save everyone an extra year of tuition.
I hear what you're saying, but don't forget, in England and in Australia, you actually specialize much earlier. You specialize in high school. So I chose a business degree when I was in 9th grade. That was when I started taking accounting courses and everything, and I was well on that way for commerce. Americans just don't do that. So if you want to take that year off, you need to also implement some type of reform in the high school process. I would say, however, offsetting that is that you have produced some excellent schools and some excellent graduates that have a very general perspective and general view on the world, and that's what inspires innovation.
She's finessing
So
this.
you
She's
get those
such a
extra
grizzled
credits in year 1 doing yoga and all kinds of silly stuff. Katrina, thank you. Katrina Dudley of Franklin Mutual Series. Thank you very much. Tom, you've got to stop calling people from Australia Qantas.
No, there's only one guy called Quantas. That's his name, really, John.
It's not going to work out.
No, his father loved the airline.
His name's Brad. You know that too.
It is.
Futures down 1% on the S&P. On the Nasdaq down by 1.3%. The hate mail from colleges around America pouring in
as we speak.
From New York.
They should read their Neville Shute.
This is Bloomberg.
Up to date with news from around the world. With the first word, I'm Lisa Mateo. China's Communist Party leadership has ignited a market rally. The Politburo promised to boost economic stimulus to spur growth and to contain the country's worst COVID outbreak since 2020. A statement said that authorities should keep the economy running with a reasonable range. It also promised to guarantee supply chains in key sectors. Inflation is the euro area. It's climbed to an all-time high. Consumer prices rose 7.5% in April from a year ago. That was in line with estimates. The new numbers will raise pressure on the European Central Bank to end the crisis-era stimulus and raise interest rates. The central bank in Russia cut interest rates more than forecast, and it indicated that borrowing costs may fall even lower. The Bank of Russia lowered its benchmark rate from 17% to 14%. Policymakers also warn the country may face a deep 2-year recession in the wake of the invasion of Ukraine and sanctions. Chevron posted the highest quarterly earnings in almost a decade. Soaring demand for energy and Russia's invasion of Ukraine strained supplies, and that led to higher prices for everything from natural gas to diesel. Meanwhile, Exxon posted earnings that missed estimates. The company took a $3.4 billion charge related to its Russian operations. Still, Exxon will boost its share buyback program to as much as $30 billion through next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question. Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Earnings season is here.
A very good quarter against an incredibly choppy backdrop.
The uncertainty is palpable.
We are cautiously optimistic.
Bloomberg breaks the numbers first.
JP Morgan, spot on.
Delta flying. Beat on fixed income trading, on equities trading.
With exclusive expert analysis.
It's a stunning statistic.
Bank earnings not resonating with investors.
What's the disconnect here?
Are they bracing for the worst?
Can the market still go higher?
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This brutal war of aggression being committed by Russia against Ukraine has brought into sharp focus the power and purpose of American diplomacy. Our diplomacy is rallying allies and partners around the world to join us in supporting Ukraine militarily, economically, and with humanitarian assistance.
That was the U.S. Secretary of State Antony Blinken there from New York City, with futures down 0.8% on the S&P. This is Bloomberg Surveillance. The Nasdaq 100 down by more than 1 full percentage point. Disappointing numbers from Amazon. A disappointing guide for the current quarter from Apple weighing on the equity market across the United States. Yields are high by 3 basis points, 285.40. In about 12 minutes from now, we will have the Employment Cost Index in America coming up a little bit later this morning. Tom.
John, as wages and benefits conflated in, it is the number I look at closest, and you wonder within the inflation debate and what we've heard, particularly a couple weeks ago from Jan Hatzius of Goldman Sachs, this heated statement of the full employment of employable America. You just got to wonder, John, is that the surprise of May and into June, legit wage inflation?
Here's the city take from Andrew Hollenhorst. They just published moments ago going into this data point. They say it's the most important data point this week. It's the employment cost index. We see upside risk and project 1.2% quarter on quarter. A surprise would not change plans for the Fed to hike 50 basis points in May, but could affect the pace of hikes down the line. Remember, they're called 4 50 basis point hikes, one after the other, through the next few months.
The parlor game of the Fed, and of course we'll do that here next week, particularly with our coverage at May 4th. Right now, we digress as all of Washington digresses with the gridiron dinner of a couple weeks ago, and there's a small soiree on Saturday, which really launches the summer in Washington. We thought we'd catch up with Terry Haynes of Pangea Policy about Washington in summer. In the old days, Terry, it was simple. There was no air conditioning, and everybody left. Now there's air conditioning. How frigid is Washington going to be this summer?
Good morning, everybody. You know, it'll be as frigid as it ever is. You know, there'll be a lot of hot air, I think, that'll move things along. You've got an awful lot of things in train here. You've got you know, continued COVID spending that's going on. You've got increased yet again Ukraine spending. You've got the whole kerfuffle about whether or not to forgive student loans and the like. Mm-hmm. You've still got the Build Back Better thing hanging out there. There's a lot of different things that'll continue to heat Washington up, but no doubt life here was better without air conditioning.
I think there are clarities or separations that we can discern of Democratic discussion. What do the Republicans look like? I can't get a handle on how many pieces of the GOP there are. How many are there?
My usual advice to folks is that you don't look at two political parties in Washington. You look at four factions. You look at conservative Republicans, centrist Democrats, progressive Democrats, and those are the four main piece parts. We get progress generally when the two centrist sides of each party come together on things like annual spending and the like. When we don't get some meeting of the minds in the middle, we usually don't get policy, and that's not a bad rule of thumb.
Terry, yesterday we heard from Janet Yellen, Treasury Secretary, as well as Joe Biden, President of the United States, on the line basically that they're using going ahead with inflation, basically calling the GDP print technical. That was Biden. And then Janet Yellen, a full-throated support of what we got out of the stimulus package, saying that that is not the reason for any sort of negativity. Are they going about this the right way, or are they basically foundering ahead of that midterm election?
They're grasping onto anything they can in order to make a case. You know, Secretary Yellen's one of the only people saying those things, as you all know as well or better than I. The consensus is completely in the other direction. And the president's been doing everything possible to deflect blame upon his own administration, but you know, that's not playing in public, and it's not going to play in public. And you know, some PR moves aren't gonna cut it. You compare those statements to, say, you know, what happened yesterday with an economic contraction, and you know, for whatever reason of that contraction and how resilient the economy is, et cetera, people hear one word: they hear contraction. And you know, that's politically, that's a gift to the other side.
And it's also perhaps a gift to the other side when they see gas prices going up as much as they are. I am wondering, especially after we got earnings from a number of the big oil companies today, what the trajectory will be for the Democrats and how that's playing with a public that frankly don't necessarily buy that it's price gouging.
Well, you know, there's a great misunderstanding about why the price of the pump is the price of the pump. That's been going on for a very long time, probably going back to the oil embargoes of the 1970s. But the you know, the bottom line, and Katrina mentioned this too. I mean, it's vastly more commoditized, number one. But number two, what people understand is that a year and a half or so ago, prices weren't what they are, and the party in power gets the blame. You know, George W. Bush got a great deal of blame when prices went up greatly in 2008, and this president's going to get a great deal of blame for gas price increases, whether he deserves them or not. But you know, you've got underpinning all that stuff. You've got an awful lot of spend going on between the COVID run out over the next several years, which will amount to about $1 trillion. Continued support for Ukraine, the student loan forgiveness is estimated to cost something like $320 billion should they do it at a $10,000 level. I mean, there's a lot of reasons why this stuff's going to be sticky and politically sticky on the current administration.
Terry Haynes of Pangea Policy. Terry, always good to catch up, buddy. Thank you. And this is the issue right now for this administration. Conversations on programs like this, we can pick out the points of GDP that were actually pretty good. There's some nuance there. In fact, the consensus on Wall Street is the GDP print of yesterday for the first quarter wasn't bad. The problem is that nuance doesn't play that well on the front page of a newspaper. So right now, this is what the optics feel like. It's uncomfortable. You've got negative growth for Q1 together with 8.5% inflation, Tom. And for the administration, rightly or wrongly, people are going to say, what have you got to say about it? What can you do? And it's just deeply uncomfortable for them to say anything, Tom.
John, I have trouble with rationalizing away the back end of the GDP equation, trade.
What sticks out? Why?
Well, trade and inventory stuck out. That's according to McKee. He knows better than me. But the bottom line is people that ignore trade, ignore it at their peril.
We'll bring it back into the conversation in just a moment. In about 4 minutes' time, we will have the ECI in America, Mike McKee, in the studio. This is Bloomberg.
Of the year, but Bali is still quiet and empty. I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping, but many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada, tapi nggak kayak dulu. Kalau dulu rame sekali, sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan, bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu, sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
we've got a little bit of data in the United States of America. It's your last stop before the Federal Reserve meeting next week on May 4th. To break that data down, we can cross over to Mike McKee. Morning, Mike.
Good morning, John. The numbers haven't crossed yet. The internet may be a little slow today, but the number we're watching, or at least that I'm watching, is the Employment Cost Index, which actually does go up 1.4%. The forecast was for 1.1, and last month it was 1.0. Now, the question is, and we'll have to get the latest details on this here, that it hasn't loaded yet, but the point is that's what caught Jay Powell's attention in the third quarter. Big jump in third quarter numbers, and the Federal Reserve, he decided, should move to getting raises interest rates going. Personal income is up 0.5%, better than forecast. The personal spending numbers 1.1%, significantly better than forecast, which was a 0.6, and personal spending was 0.2% in the month of February. Now, the important thing about this to remember is these are backward-looking numbers. They're already in the first quarter GDP numbers, but they do suggest that we saw a pickup in spending over the last month of the first quarter, and after the COVID sort of squeeze in January and February, it did show consumers coming back, and so that is key. The deflator numbers, the PCE, this is the Fed's favorite inflation index, up 0.9%, the month-over-month rise, and that's much higher than the 0.5 that we saw in the month of February. On a year-over-year basis, up 6.6%, which is higher than the 6.3% for February, but lower than the 6.7% Wall Street was expecting. The core up 0.3, matching last month, and the core year-over-year 5.2%. That's lower than the 5.3% we saw in February and the 5.3% that was expected. So basically, the story here is, again, the divergence we're starting to see between headline and core inflation. Headline driven by food and energy, and core not rising as much. This is playing out a little bit like the Fed expected, but as you were saying before you went to the break, it's hard to put all that into a newspaper headline.
I can tell you right now, as soon as that employment cost index dropped, this bond market shifted in a big way at the front end of the yield curve, up 10 basis points on a 2-year to 272. Bear in mind, just go back a week, the high of the year was 278. So we're still off that high of the year coming into the Fed next week, but we readjust in a material way. Up 11 basis points going into the Fed next week at the front end of the curve, Tom.
I went right to the 2-year yield as well. Mike McKee, before we get to Tom Porcelli, I want to talk to you about ECI, and that I looked at the spike we've seen in the ECI measuring wages and benefits, and I did a standard deviation model. We don't need to show it on radio, but the bottom line is it's a spike. That word spike, that's what we have. Is the ECI spike the same as an inflation spike, whether it's German inflation or U.S. inflation?
Well, it would, in theory, feed into a wage price spiral, because workers would look at inflation and say, I need more money. What we don't know at this point is whether this is because companies are paying up still to try to track workers back in, or because we're getting some second round effects. Wages and salaries went up 4.7% in the first quarter, according to the ECI. It was 4.5% in the fourth quarter, and that had gotten Jay Powell's attention. So 4.7% does not suggest good news. Nothing slowing down about wages at this point.
Perfect to get to Tom Porcelli, who joins us now, truly expert within market economics in America on wage dynamics. Tom, you're the best guy to talk to about this right now. Is it a wage spiral?
Yeah, so I'm sympathetic to everyone looking at ECI because Powell mentioned it, but I don't know, it's a quarterly number. I mean, there's monthly stuff in hand. We have a month. We have a new month. We have March in hand. We're going to get April data soon enough. I mean, look, if you're looking at wages and salaries, I think it's really interesting that the month-on-months actually continue to slow, and that's been going on for quite a number of months now. Again, make no mistake. I mean, we're looking at really high run rate here, but at the end of the day, look, everyone wants it so fast, right? Like, they just want it, like, 1 month they want to wake up one day and they want, like, inflation back to, 2%. This is not how it's going to work, right? I mean, you have to look for, like, these sort of little shifts that are happening. And I think there's a couple of interesting shifts that are happening right now. One of them is wages and salaries are actually slowing down on a month-on-month basis. Again, running at a high level, we get that, but you got to look for these little shifts. I thought the beige book from last week, I thought that was really interesting too. I mean, there was this commentary embedded throughout, again, right, like the things that you're not going to see at the headline. I'm looking at the comment right here. I thought it was really interesting. A few firms noted that they're reevaluating their employment level and may be ready for some attrition to reduce staff size. And comments like that are embedded throughout the beige book. Now, again, I want to be clear. You're not going to wake up one day and everything is going to be sort of different. I'm just simply saying you got to look at these things for sort of, signs or how things are starting to shift. And I would submit to you that is happening.
So you know what it means for markets, Tom, and you're right to pick up on the ECI. The reason people care is because Chairman Powell told us he cares. This is about the reaction function of the Fed. So let's work through it together. How do you anticipate this data will develop? There will be a mechanical peak developing in CPI in America. We may have already seen that peak. Tom, how do you think this Federal Reserve will internalize that data and react to it as it peaks and you start to see this slow deceleration that I assume that you anticipate through the summer?
Yeah, Jonathan. So I think that this is the question that, we just wrote about this the other day, and I think this is the thing
Connection lost.
The Fed is going to need to sort of quantify to some extent. Think about last year. Think about what they did last year. Last year was basically all about getting to max employment, right? Like, forget about inflation. It was a beeline to getting to max employment. Well, we see how that worked out, right? When you have your blinders on and you're only focused on a single side of the mandate. So the question today is, are they only going to focus on getting back to target inflation? Because I'll tell you, if that's true, look, you're speaking to someone, and I think you all know this, you're speaking to someone who actually thinks that inflation will slow down as the year progresses. But if this is a march to target, then you're going to blow through Bullard's 350. I mean, you're not going to get to target until well into next year from a core perspective. So I think the Fed needs to define what they sort of will feel comfortable with from an inflation perspective, because if it's target, then you're going to be meaningfully higher than neutral, and you're going to cause a recession.
So where do you think that they should be okay or comfortable with inflation coming down to?
Yeah, Lisa, I think that it really is about the movement of inflation, right? Like if by the end of the year you're holding a free handle on core inflation, I would define that as actually feeling like you're in a good spot, right? It's about the movement and where we are going. It's about the narrative in place at the time. It's really easy today to say, hey, inflation could be at 8%, because that's all people see is 8% inflation. But I think as the year progresses, I think the tone on that will be very different. I think as the year progresses, the tone on spending will be very different. I mean, we've talked about this quite a bit. If you look at the lower end consumer at the fourth and fifth income quintiles, they're tapped out. They don't have the ability to overspend, which is what happened last year, and the data are pretty clear on that. I think it's interesting. I was listening to you guys earlier, and I think Tom was completely spot on. I think that yesterday's GDP number, I think that's fascinating. I think that is a really interesting report. It has nothing to do with the negative. It's nothing to do with the fact that the consumer held in. I think it has everything to do with trade and inventories. And this is, again, feeds into our story so nicely. I think it's really interesting that the inventory build has been staggering over the last couple of quarters, absolutely staggering. And yes, it's subtracted from growth yesterday, but only for because of the way is the delta, right? It's just because the build was less than what we saw last quarter. But the last 2 quarters, we have seen an absolutely enormous amount of build. Think about that in the context of the other thing that's subtracted from growth. That was trade. We've imported almost the annual run rate is 18%. 18% over the last 2 quarters. This is amazing.
Well, Tom,
and so what's happening is, let me just finish this point. So what's happening is we're building all of this inventory at the same time that the consumer is transitioning from goods spending to services spending. What do you think is going to happen to goods prices in that context? Goods prices are going to fall, and I think they could fall pretty sharply.
Just real quickly, we only have about 45 seconds left. It's no problem. Yeah. I know that your view is that the Fed shouldn't go too quickly and force a recession. What would you have to see in the data that would make you change your mind about the momentum that the Fed has to curtail?
So Lisa, if we're wrong, if inflation remains elevated, then yes, of course, then the Fed should engineer a recession, right? They basically should just get aggressive and knock this thing out. But again, I think well, I've said this many times on your program. I just think a little bit of sort of patience and a little bit of sort of making sure you're sort of noting both sides of the mandate. I think that will get you to a pretty reasonable place. You know, we don't have to generate a recession. I don't think we'll have to generate a recession if inflation slows down. But if it doesn't, then yes, I think the Fed will necessarily have to get aggressive.
Tom, do you think the pivot was more to do with securing a second term and not the ECI then? Just a final question from me.
You know, Jonathan, I don't think so. I mean, I don't pretend to know Jay Powell in any meaningful way. But I don't think that was driving his thought process.
Just inquiring minds want to know, Tom, what you thought.
Yeah.
So, thank you, sir.
Yeah, I don't think so.
Tom Porcelli of RBC Capital Markets. Thank you very much.
Conspiracy theories.
Just checking in, Tom. Just having a word. In the next hour, big conversation with Mohammed Al-Arian of Bloomberg Opinion and, of course, of Queen's College, Cambridge. We'll get his view on the latest economic data, the latest earnings and what it means for this market and, of course, for central banks. And then after that, the view from the White House, Tom, with the National Economic Council Director, Brian Deese, coming up in about an hour from now.
That's a more important conversation than it was 24 hours ago, John. I mean, he's got to massage a negative GDP statistic wrapped around, as Tom Porcelli suggested, 2 of the 4 quintiles flat on their back, 2 of the 5 quintiles.
It's going to be an interesting one. It's an uncomfortable moment to explain. Negative growth and inflation at multi-decade highs. Futures down 1% on the S&P, on the Nasdaq down by 1.28%. Amazon, the big loser of the day, down and down hard in early trading. On TV and radio, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. President Biden has broad support from Congress for a massive $33 billion Ukraine aid package. Lawmakers could finish work on the measure by the week of May 9th. But if Democrats insist on attaching funding for coronavirus vaccinations and treatment to the package, action could be delayed indefinitely. Officials in China are defending the COVID-0 strategy as still the best way to fight the pandemic. They say the outbreak is coming under control, with cases in Shanghai showing signs of turning around. The lockdowns have been criticized for exacting heavy social and economic costs. Law enforcement authorities are searching Deutsche Bank's Frankfurt headquarters in potential money laundering case. The prosecutor's office says the raid relates to reports made by the bank. Deutsche Bank is said to be cooperating. Cathie Wood's flagship ARK Innovation Fund is headed for its worst ever month. With a day's trading to go, the ETF is down 26%. The fund has declined almost 70% from its all-time high last year. Key holdings like Zoom and Teladoc Health tumbled from their pandemic-inspired records. And the fracking boom is turning Texas into the earthquake capital of the U.S. West Texas, the oil drilling center of the country, is on track to overtake California and Alaska with the number of quakes measuring 3.0 or higher. There's little doubt that there is a link between the drilling and the jump in seismic activity. Even industry insiders acknowledge that. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA.
is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Fed needs to get to above 3.5% on the Fed funds rate. If inflation remains stickier than we anticipate, if you get further supply side shocks, it's possible the Fed has to be even more aggressive than that. And ultimately, if you look how far the economy is from the Fed's targets on inflation in the labor market, we just don't see a soft landing as the most likely outcome.
Mr. Luzetti of Deutsche Bank there, updating the recession call for Deutsche Bank. I'm sure over the weekend they'll do a reanalysis. Lisa and I will be really diving into the weekend notes. JP Morgan starting with their weekly prospects this Friday evening, and we'll read them through the weekend as we go into May as well. Right now, and in his wheelhouse, and I really want to stop here for a moment with the host of Masters of Business, and yes, the Chief Investment Officer at Ritholtz Wealth Management. Barry Ritholtz has a wonderful, holistic sense of finance and of investment, but his absolute wheelhouse, and when I first met him was at some public event. I think Nixon was president, I can't remember, but Barry talking about the obvious in front of you and when to not listen and to trust the process. He has written a memo in these tumultuous times, and the process, it is the heart of Ritholtz 101, and I'll editorialize, Barry, you're dead on. Barry, I looked at the May note from Hindsight Capital. What's the process over at Hindsight Capital?
Yeah, so this is a concept that my Bloomberg colleague John Authers started back in, I think, 07 or 08 when he was at the Financial Times, and he talks about how successful we all are when we know what already happened. And unfortunately, investing is a forward-looking process and not a backwards-looking process. And my favorite thing that's going on right now, you have volatility of the market down about 10%, and the hotter sectors like tech down 20%. Right around now, everybody becomes an expert at what you should have done 6 months ago. And, that's not how investing works.
I look, Barry, at how investing works, but we do have to recalibrate out of this, and we recalibrate off of Amazon and Apple, their struggles with supply chains and all the rest. Do you ignore that noise, or is that part of the analysis at Ritholtz's hindsight capital?
So ignore is the wrong word. What you really need to do is put it into context and understand the long term. And there are two moments that challenge long-term, long-only investors. That's when they buy stocks, and that's when they hold stocks. And so the buy stock, when you're buying something, whether it be an index or a specific company, you're full of hope and you're wishing for the best, and you sort of, strap yourself in and get ready for the ride. That's actually the easier part. The harder part is when we go through these drawdowns, which, by the way, are normal. They're a feature of markets. It's not a bug. 2020, 2021 especially, where there was no volatility, we didn't even get a 5% drawdown. That's the abnormal situation. The reason we make money in equities, the reason stocks are such an attractive asset class is because they're hard to hold on to through these moments. And if you can, put your behavior under control and put your emotions in a box, the less you do during these times, the better off you are.
Sure, Barry, and this is definitely the luxury for a lot of people who have money in the market and who perhaps are not looking to put extra money to work. But there are a lot of people, particularly as they get bigger bonuses or whatever else, that are trying to figure out, okay, well then do I enter now or do I wait? And it's the idea that you just keep going and just do it whenever you want to do it. If you were looking with hindsight capital, is this a good moment to go, for example, into the NASDAQ after more than a 20% drawdown?
So I'm going to give you a two-part answer for that. First, we'll give you the broad academic answer, and then we'll drill down. The broad academic answer is 2 out of 3 times, 65% of the time, you're better off putting the dollars to work right away than you are dollar cost averaging in over time. In other words, you get a windfall, you get an inheritance, you get a bonus, whatever that lump sum is, you win the lottery, putting it in immediately is a higher returning strategy than, DCA over time. And the reason for that is pretty simple. Most of the time, markets tend to go up, and when they go down, they tend to be shorter, sharper corrections than what we see under normal circumstances. So that's the academic research, and that's the theory. Specifically, when you're looking at individual companies, and go back to, the post.com collapse of 102, 03, lots of companies that collapsed were spectacular buys like Amazon and Apple. But lots of companies that collapsed, forget returning to their all-time highs, they never got appreciably above those post-collapse lows. And so when you're not buying a broad asset class, when you're buying specific companies, you're making a bet on that individual company and not mean reversion. Buying the S&P 500 or the Qs down 50%, down 30%, that's a mean reversion bet. But a specific company, you don't know if they're going to be are they AIG or are they Lehman? You don't know.
Barry, thank you so much. Look forward to your report on Hindsight Capital in June. Barry Ritholtz with Ritholtz Wealth Management. Lisa, we got to look at a 2-year yield, which just flat out resets. Basically, folks, the ugliness of X number of days ago, things get better, yield comes down, boom, 12 basis points, 2.74% on the J. Powell note.
Yeah, we're getting to those post-2018 highs yet again, with people pricing in that J. Powell cannot look at that ECI, that employment cost index, coming in at the hottest in data going back to 1995, and say, well, maybe we should just take it slow and be patient. And you're seeing this just spread out throughout markets. I do wonder how they're going to dovetail both the GDP, which has some concern in it, as well as this employment cost index showing that sort of, slugflation, as Doug Cass would call it. And I do wonder how they're going to message some sort of certainty amid such uncertainty.
Well, the message is just do something, and the just do something is timed to an election year. So I think there's the political debate, which is so important. And also, quite frankly, there's the market debate, which I believe we could say it's been tested in April, Lisa?
I think that's a fair thing to say. Worst month ever.
I mean, I'm in triple leveraged all cash. I don't care, but continue.
Yeah, worst month ever for global bonds, and definitely a really painful month for the NASDAQ. I also want to point to Amazon ahead of the open, extending losses, down now more than 10% ahead of the open. Sort of shocking considering how big of a weighting this is in the index. And really, yes, it is a tale of two different techs, right? This is going to be considered more consumer discretionary, perhaps. Then how does that get treated in an era where perhaps there's a bit of a slowdown that we're not just yet seeing with the consumer?
Setting up for the weekend, Lisa, and I think it's very, very important to understand we're going to be just buried in our reading all weekend. But clearly, Lisa, after the uproar yesterday, a mandate for a triple viewing of Caddyshack, Animal House, and the true classic Stripes. I mean, I think that says beginning of May.
And that says lots of Tang. And then some more Tang.
Well, there'll be an add-on to the Tang.
Yeah, I have no doubt. It'll be fun to get through and have fun.
Well, I'm like, the grandson of Ted Knight in Caddyshack. I'm just going from drink to drink at the country club. Jason Furman, 12 noon on radio, on television. Good morning.
At the Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
What a week this has been. Teeing up a big week next week from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Live from New York City, we begin with the big issue, wrapping up a big week for earnings.
It's a pretty critical week. We've been on a roller coaster ride.
So far, the earnings season's been really reasonably good. Earnings have actually been quite strong.
What's not coming in strong is forward guidance.
It's not a great backdrop right now.
Companies are reluctant to really push guidance forward.
The environment's still very uncertain.
We're seeing a big divergence between some of the winners and the losers.
There is a sense that there could be some demand destruction.
You're actually seeing companies pretty bottomed out.
Some of the positioning in these larger cap tech stocks is so negative.
Even though they may have disappointed.
It's been better than expected.
So there's a lot to parse in earnings, but a lot to be positive about too.
The earnings of the last 24 hours speaking to pretty much every single thing that everybody is concerned about right now. And capturing that story is Amazon, down by more than 10 full percentage points. Breaking it down, here's Kelly Lyons.
Yeah, absolutely brutal, John. Amazon could see more than $100 billion worth of its market value wiped out just today. And of course, that has implications for the broader market, considering what a behemoth this company is. And it's not just Amazon either. You also have Apple, which is off of the session lows in pre-market trading, but still down about 1.3%. So that creates a drag too. Of course, for Apple, the issue wasn't so much about the quarter they reported. It actually was a record for a non-holiday quarter. The issue was its warning on the supply chain constraints it is facing, particularly in places like China, saying that could wipe up to $8 billion in sales off of the next quarter. Now, for Amazon, the issue really is the disappointing forecast. The company is battling headwinds on a number of fronts. First, you have inflation, higher labor and freight costs, but also the inflation that's biting the consumer, maybe altering their spending patterns, which already were changing as we emerge from the pandemic. So you have supply side issues and a softening in demand. And the company saying yesterday, yeah, we may be overinvested in warehouses and people during the pandemic boom. It's worth noting, though, that the secondary businesses for these companies, AWS for Amazon and Apple's services business, still doing pretty well. As for the other reports in the last 24 hours, we have to talk about big oil. You are seeing blowout profits that actually still missed expectations, but for Chevron, the highest profit in almost a decade. For Exxon, a doubling of its profit year on year, though both did come up a little shy, which is why the stocks are down at the moment. But for Exxon, they said that does include a $3.4 billion hit because of the exit of its Russian operations. It also tripled its share buyback program to up to $30 billion. So, John, to be clear, they are raking it in due to higher oil prices, and they're returning money to shareholders. I really wonder how President Biden views these results this morning, John.
We're going to get the reaction from the White House in about 40 minutes, Kaylee. Don't worry about that.
Looking
go
forward
through
to
the earnings, go through the earnings, talk about that buyback, and talk about how awkward, uncomfortable that might feel for them. Andy Jassy over at Amazon said this: "We're no longer chasing physical or staffing capacity. Our teams are squarely focused on improving productivity and cost efficiencies throughout our fulfillment network. We know how to do this. We've done it before. This may take some time." Joining us now, a man who had an edge through the last year on inflation by listening to corporate America. Mohammed Al-Erin of Bloomberg Opinion and Queen's College, Cambridge joins us right now. Mohammed, you got your edge last year because you told us repeatedly that you looked to corporate America to listen to what they had to say about what was happening with this economy. What have you heard this quarter?
We've heard two things this quarter, and thanks for having me on, John. The first thing we've heard is that the supply side remains an issue. Whether it's supply chains, whether it is employment cost, it remains an issue. We're also hearing something new, which is that corporations are starting to worry about the demand side. They're starting to worry about demand coming down. So if you think of it, we had a supply disruption, but demand is fine. They're telling us the supply disruption will continue, and keep an eye on demand because that's starting to weaken, which when you translate for the economy means stagflation. And what that means for the Fed is the most challenging paradigm for policymaking.
Mohammed, let's talk about what it means for the Fed for next week. Are you saying the decision that they have to make is getting harder, not easier?
I'm saying the short-term decision is easy. They've got to hike 50 basis points. And today's employment cost index, which again came higher than expected, and you have wage increases in the 5% range. When you put in benefit and everything else, you've got employment costs going up at 4.1%. 40-year high, they have no choice but to hike 50 basis points. But it's the longer term that's getting harder. You know, I've always said they needed time, skill, and luck. And because they are so late, they don't have time anymore. So they're going to require even more skill and a lot more luck to soft land this economy.
Mohammed, I'm very interested to what you think will happen at the back end of the summer. It's clear to pretty much everyone that we'll see a mechanical peak in CPI year over year just because of the base effects through this summer. How do you think the Fed's going to respond to that as inflation does decelerate? Not necessarily quickly back to 2 or 3, but certainly down from 8 through 7 onto 6.
I don't think they're going to focus much on headline. They're going to focus on the core PCE. They're going to focus on the ECI. And that is not going to come down quickly anytime soon. So inflation issues are going to remain for them through the summer and into the fall. What's going to be worrisome for them, I suspect, is that the economy is going to slow a lot faster. And they are going to see the type 1 error versus the type 2 error. Type 1 continues slamming on the brakes and risk a recession. Type 2 is ease off the brakes and risk an inflation problem well into 2023. That is the trade-off we wanted to avoid. That's why a few of us were urging them to move last year, and now it's facing them right there in front of them.
You believe they choose the latter, not the former. Why is that?
I do. I think ultimately they're going to ease off a little bit, try to see whether they can minimize the impact on growth, and then have to hit the brakes hard again. You know, we're going to have the stop, go, stop phase, which is going to be really unsettling both for the markets, but most importantly for the economy. It's going to be rather unsettling longer term for the economy.
Mohammed, given the world that you describe and the outlook that you've just illustrated, where do you think this so-called neutral rate actually is versus where they think it is, and how on earth do you come to that conclusion?
So we discussed it last week, John. I don't know what the neutral rate is, and I don't think anybody knows what the neutral rate is. They're going to have to go through a process of price discovery, just like the markets now are going through a process of price discovery. So they're going to have to go through a process of discovery till they have a feel for where it is. There is no free lunch. When you distort markets for this long, you have to pay the consequences, unfortunately. And one of them is that it's not clear where you should be going because you've distorted so many signals in the economy.
How would you characterize the current process of price discovery, Mohammed? We reflected on this last week. Let's build on it a little bit more together. We're seeing another big move at the front end today by 12 basis points on a 2-year to 274. Off the intraday highs of the year, granted, but still pretty whippy price action, Mohammed. How would you describe it?
Oh, enormously whippy price action. And that's because the marketplace is trying to figure out inflation, growth, earnings, past earnings, future earnings. But in addition, liquidity isn't as good as we once had it. So you get outsized move. You're showing the 2-year rate today. That's up another 12, 13 basis points just today. The 10 years up 7 to 8 basis points. We've been on this roller coaster. And you hear me say this, keep an eye on liquidity, because the last thing we need is a market functioning problem. So what the volatility is telling you is not only are there competing forces on fundamentals and on positioning, but also liquidity is not as deep as we would like it to be.
Mohammed, that introduces the BOJ question. Let's talk about the BOJ. Yes, there's a lot of whippy price action in the Treasury market. In the Japanese government bond market, they don't want any of that. They're trying to cap a 10-year yield at 0.25%. In the meantime, what's developed over the last month is a massive move, gap higher, in dollar yen. What do you think gives there? How do you read that current situation?
It's absolutely fascinating. It's not often that a major central bank wants to swim against the current. That's what developing country central banks try to do once in a while, and they learn quickly. So the Bank of Japan is trying. The Bank of Japan is trying to remain ultra loose at a time when the other major central banks are starting to tighten. So what happens? You said it. The currency weakens to levels that we have not seen for a very long time. Now, the first phase of currency weakness is welcomed. It's welcome for 2 reasons. It enhances competitiveness and it reduces the risk of deflation. So I suspect the Japanese welcomed that first phase. But this month, it became somewhat disorderly. So I suspect they are more worried, and Japan's trading competitors should be more worried. So it's not going to be as easy. I think ultimately the Bank of Japan is going to have no choice but to follow the other central banks.
That final point you made, no choice but to follow the other central banks. Let's say they wait, and they have a problem. Mohammed, a final question for me is whether that is just their problem or our problem. You touched on it briefly there, the trade relationship. Do you think it is just their problem, or is this our problem? And if it is, why?
So it's mainly their problem. Japan is not as important to world trade as it used to be. So this is not the 80s. This is not where you get the currency accords, plaza, etc. So it will be an irritation in terms of the international system, but it's not going to be a massive problem. John, the one thing we've got to get our mindset above is this notion of little fires everywhere. You're going to see little fires in developing countries, in Japan, here, there. And it's important to realize that's the sort of world we live in right now, is that little fires are going to erupt all over the world because we're going through these major changes and we don't have the policy flexibility that we normally would need to navigate this in an orderly fashion.
From a macro perspective, Mohammed, do you miss being away from a trading desk in a moment like this one?
So I actually feel sorry for people having to trade through this volatility. What I do miss is being surrounded by really smart people at PIMCO to discuss these various things, because I think this is a very fascinating and interesting time where lots of things are moving, and trying to focus on the 3 or 4 that are most important is really hard.
We're lucky to get your time instead, and lucky this morning as well. I know you were super busy this morning, so thanks for making time for us. Mohammed Al-Arian there on the latest situation, and it right now is a tough one, including for Amazon. That stock is down by more than 10%, breaking things down. It's Taylor Riggs.
Yeah, John, why don't we start there with Amazon? I have to admit, I was totally flustered yesterday when the earnings sort of came out at around 4:30 or 4 p.m., I should say, because remember with Amazon, we typically don't get a loss. When we were looking at the second quarter operating numbers, and it said a loss of $1 billion instead of a profit on the operating basis of what we were looking for about $6 billion. Totally, I think, caught the market off guard. That's certainly a reflection of what you're seeing. Let me go back up to the screen as well as Apple. Don't get me wrong, John. Every analyst on the street says that these numbers are phenomenal. Yes, they talked a little bit about some supply chain issues, but if you think about a $90 billion buyback, they pull in $90 billion of free cash flow a year. They're literally doing that just to be cash neutral at this point. That is how much money this company continues to generate. I want to go to the downside a little bit and talk about some of the oil and gas companies. I'll focus here on Amazon. Look, they're also tripling their buyback to about $30 billion. Cowen coming out and saying the EPS miss was pretty much a result of just $1 billion transitory item, like weather, like timing. The buyback, of course, should help outweigh some of these transitory earnings miss. Overall, these companies are still doing a very good job of generating some of that free cash flow, despite what a little bit to the downside of this market would tell you this morning.
Taylor, awesome. Sticking with us through the opening bout. Taylor Riggs there. Coming up on the program, the Fed casting a shadow over corporate America.
We've taken pricing this year, and we are in an inflationary environment. The pricing that we have taken has stuck, and we'll continue to manage that.
A big week for the U.S. economy and global markets coming right up.
About what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We've taken pricing this year, and we are in an inflationary environment. The pricing that we have taken has stuck, and we'll continue to manage that. You know, you'll probably see if inflationary pressures continue, commodity prices continue to increase, you'll see additional price increases.
Corporate America grappling with surging inflation, investors gearing up for a huge week ahead, with economic data and Chairman Powell very much on deck. Mike McKee has more for us. Morning, Mike.
Morning, John. Well, we got some interesting news this morning that may affect the Fed's thinking longer term. They're already locked into 50 basis points for next week. But where's the economy going from here? The Employment Cost Index, which got Jay Powell's attention last fall and sort of forced the issue of starting rate increases earlier, rises at the fastest rate ever. It only goes back to the early 1990s, but that is still 30 years of bad news packed into one number. Now, the white line here is wages and salaries. They're still going up at a strong clip. It is also the PCE index for the headline and the core. And you can see one of the stories being told this morning is that we're seeing a wider divergence between the headline, oil and food driven, and core prices. Core prices actually down a little bit from last month. That may be some good news going forward. Now you take a look at what we made and spent. Personal income was up 0.5% less than it was in February, but spending rose dramatically. Now part of that's inflation, but part of it is maybe coming out of COVID. Wages and salaries in this index slow a little bit. So what's really happening? ECI's quarterly. Pandemic aid disappearing now. Savings rate falling a little bit. Maybe we're spending some of the money that we put away in the bank. As you mentioned, John, busy week ahead. What's next? The Fed decision is going to overshadow everything. 2 p.m. Wednesday. Consensus is that 50 basis point hike will be at 75 to 100 basis point range. We'll get the balance sheet runoff, start and details. And then we're going to forget all of what I just said, and people are going to start saying to Jay Powell, what's next?
75, 100. Mike McKee, you know how this works. Mike, looking forward to your coverage through today and into next week as well. Joining us now is RBC's Amy Wu-Silverman, Krishna Mamani of Lafayette College. Amy, first to you. Are we seeing a permanent shift into a higher vol regime? And if we are, what are the factors driving that, and why do you think they'll persist?
Look, I think we are. You know, you don't have to look at the VIX numbers to feel the volatility viscerally, even this week with the whipsaw that we saw. And, you know, when you look at this historically, John, to the past 30 years, when you shift vol regimes, so, you know, kind of from a 20 to 30 to 30 and maybe even higher, this is generally pretty bad for stock returns. In the years where VIX kind of averages 30 or higher, that equates to about a down 11 to 15% return on the stock market. And part of that, obviously, is the Fed put being removed, accommodation being removed, financing being tighter. All these fundamentals are driving a far more uncertainty for single stock factors as well as macro.
And Krishna, I'd love you to build on that. Do you think that that does tell us something about potential equity returns through the future?
Absolutely. So I think a couple of points with respect to volatility. First, clearly volatility is going up, primarily driven by what the Fed is going to do in the near term. But there's an equally important case to be made as to where rates are going to be if and when we come out of this recession because of the defense spending that is going to take place in Europe and everywhere else. So I think if you state that we have probably seen secular lows for rates, I think that simply implies that volatility overall is probably going to be higher coming out of if we have a recession. So there's no respite. This is going to be a very challenging environment for stocks and asset prices in general over the next few years.
Amy, you've made the point that we've finally shaken out this mechanical buy the dip mentality. Can you run me through the implications of that?
Yeah, you know, there are many things that we sort of got used to during the pandemic. For those of us in the options world, we got used to retail call buying. It was something that we expected to be there. And then obviously over the 10 years prior to that, we got used to positive momentum. You know, stocks going up, got more stocks going up. And obviously that's not happening anymore. And you're also taking a core pillar out of who was doing that buying. So I think those things obviously have not only implications to the options market, but on every earnings you're seeing. You saw this on Netflix. Options were applying an 11.5% move on earnings, John, and it moved down 35%. We're consistently seeing these beats, and I think they'll continue in terms of volatility being something that you own during earnings season.
Krishna, there was a piece that Amy Silverman just went through there that I think is so important. There was this massive flood of money buying short-dated call options in this market. And as Amy pointed out, buying beget more buying, and you just saw this market push higher, particularly for the back end of, say, 2020. Can you reflect on how supportive that has been as a pillar of demand, Krishna, in this equity market?
This has been one of the primary drivers, and I think meme stocks is a really good example. When you can take a really crappy stock and can run it up, that puts a fear of God in anyone looking to short things. And that in turn has implications for how things are going to be valued in the marketplace. So I think that is being phased out. I think retail involvement will certainly go down if we have a significant drawdown. Volatility would be higher, rates are higher. All of that is pointing towards prices being vulnerable, and in an environment where prices are vulnerable, retail involvement is going to go down as opposed to go up.
So Amy, it makes me ask, what's the trade? What's the conviction trade for you now?
Yeah, look, it's slightly bifurcated in terms of an answer, but there continue to be interesting companies where they're making money, they're still high quality, and you're seeing them buy back stock. So what's interesting about that, John, is when companies buy back stock, this tends to dampen the downside, tends to dampen skew. But in an overall market correction down, moves are correlated. So if you own puts on these kind of stocks, even though they're high quality, in the near term, if you get these macro-related moves down, it's slightly cheaper to do it on those names than it would be on something that's already, you know, a very high, like an ARC or something where we already know that momentum factor is being priced into the volatility.
Krishna, final word.
Well, so I think even away from options, quality is really where the money has to be put, because you have substantial risk, and if you want to capture the upside for equities and want to remain involved in the market, you want to protect the downside meaningfully, and quality is where that is going to happen, nowhere else.
Krishna, awesome. The both of you, fantastic to catch up. Krishna Mamani there, Amy Silverman, breaking down what's been happening over the last couple of years and how things have been changing much more recently. Coming up in the morning calls and later, Apple and Amazon feeling the supply pain. We're going to catch up with a tech bull, Dan Ives of Wedbush. He joins us around the open and bow from New York City this morning. Good morning, with futures down 1% on S&P.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes away from the opening bell this morning. Good morning. Apple and Amazon make up about 10% of the S&P 500, and those two names, those stories, aren't great. We're down about 1% on the S&P, a little bit more so on the Nasdaq. That's the price action. Here is your morning call. Your first one comes from Piper Sandler, downgrading MasterCard to underweight, growing increasingly concerned that Europe could enter a recession next year. Your second call from MoffettNathanson, upgrading Roku to neutral, highlighting an improving macroeconomic environment and accelerating spending trends. That stock's up by almost 7%. Not quite the Netflix story there, hey? And finally, Wedbush keeping its bullish view on Apple after earnings, saying China issues are temporary and not a reason to sell the stock. We'll get our teeth into that in just a moment. We'll catch up with the man behind the call, Wedbush Managing Director Dan Ives, joining us, taking us through Apple and Amazon and a whole lot more. Futures down about 1% on the S&P 500 from New York City, closing out the week and the month next.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bow this morning. Good morning. Looking to open up the session this Friday, close out the week and close out the month. On the Nasdaq on the month, down almost 10%, heading for the worst month, the biggest monthly decline on that particular index, going all the way back to 2008. Futures right now, negative. Switch up the board and get to the bond market. Yields higher on a 2-year, on a 10-year by 10 or 11 basis points. The 292.58 going into the Fed next week, coming off the back of an employment cost index that surprises to the upside. Euro dollar pulls back from session highs, 105.26 and positive 0.25%. Europe has its own inflation problems, 7.5% on CPI, and core heading in the wrong direction for this ECB. Crude hanging in there, 106.61, a ton of corporate earnings from the oil patch we need to talk about. Crude up by a little more than 1%. Let's break down the movers and cross over to Candy Lines.
Well, John, there's really one mover that matters the most today, and that would be Amazon. It is absolutely plunging at the opening bell, down by double digits, around 11% after that disappointing revenue forecast. The company basically saying we overinvested in people in warehouses during the pandemic. Now it's looking like demand may be fading. That stock down heavily as a result. Apple only opening by about 1.2% lower, so well off of the pre-market lows. But of course, the issue there is the warning around a potentially $8 billion hit on revenue in the current quarter due to supply chain challenges in places like China. You were talking about big oil as well, John. Exxon up about 0.6%. Its profit doubled due to higher oil prices. Chevron reporting the highest profit it has seen in almost a decade. And of course, the story with Exxon also includes a $3.4 billion charge due to the planned exit of its business from Russia. But no worries, they still have plenty of cash to return to shareholders, tripling that buyback to up to $30 billion, John.
Not shy about it, are they, Kaylee?
Not at all.
I thought they might be, but they're not at all. Kaylee Lines, thank you very much. What a month it's been on the Nasdaq. The Nasdaq 100 heading for its worst start in about 2 decades, the worst start to the year. On the month, we are down by almost 10%. We have shedded $1.8 trillion in market value this month alone. Taylor Riggs, the numbers are staggering.
The numbers are staggering, John, and Kaylee sort of already took us through sort of the quarterly results and what we heard last night, but it's Apple, it's Amazon, and then really it was Intel as well. Hard to sort of not feel here for Pat Gelsinger, of course, sort of being brought in, but our very own Mandeep Singh, of course, also saying that this is just a big ship to try to turn around, and indeed they need more time. So you're also sort of getting the sense that big tech here, at least on Intel, is certainly to the downside. The Western Digital, a little bit to the upside here, and we've heard similar sort of positive stories from some of the other chip makers as well. So really been a push and pull here, but overall big tech, like you said, it has just been bad. I want to sort of put into some size and scope here. I was taking a look, Google on track for its worst month since 2008. So it's been a bad April. Amazon on track for its worst month since 2018. It's been a bad April, and it's been a bad April pretty much across the board, if you can see there. I think what's interesting, and you can talk to Dan Ives about this, is sort of the increasing bullishness, though, despite this. I think going forward, we've been taking a look at where sort of analysts are thinking about estimates for the NASDAQ 100, still looking at sort of the year-end price targets on a 12-month basis of about 17,000. So that's showing a pretty sort of bright future if you think about where we are now, John.
I was going through the analyst page on Amazon, Taylor, just going through the ratings. 57 buys, 1 hold, 1 sell. The south side's still in on this name, and this name has struggled for more than just a month.
And ask about the price split. I think we were asked Poonam Goyal, of course, over who covers Amazon for us here, and still going through with the split of about 20-1, if I'm correct. Of course, we know on a fundamental basis that doesn't make a difference. Does it help when we think about the weightings of how it is within this index? But again, Andy Jassy sort of addressed this, saying we've been here before. We've talked about losses before. It takes time to turn it around, but it's not new to the company. If you think about the origins of this company and the losses, they've done this before and they've been successful. That might be where the hope is for this company.
Taylor, thank you. Amazon down by more than 10% in early trading. Apple actually coming back, only down by 0.2%. Dan Ives of Wedbush is still bullish on this name in a big way. This is what he had to say. The China and supply chain issues should peak in the June quarter and then subside into the key September and December quarters. This is not a reason to panic and sell the stock. Still got an outperform rating, still got a $200 price target, joins us right now. Dan, why don't you see a demand problem in quite the same way that others might?
I mean, because ultimately, if you take out the 4 to 8 billion, numbers are going up by 3 to 4 billion. In other words, the underlying demand is stronger than the street anticipated. Now, look, the COVID shutdown in China clearly hurts them in terms of the June quarter, and it could ultimately trickle into September. But John, we continue to focus on the demand story. I mean, that continues to be the key why you buy Apple. Selling it on the 4 to 8 billion hit this quarter would be, to me, that would be the wrong move. That's what we've been telling our investors last night, this morning. This stock's down every day of the week you're buying this because of the demand story from iPhone services.
Well, they're already buying it off the lows right now, 163.70. The problem people have, I think, Dan, beyond just a single name, is how to value any of these names in this current environment. I caught up with Brent Thill at Jefferies. Take a listen to what he had to say.
Pushback right now is no one wants to buy anything in tech. So it's not just Amazon. Go pull up a chart on Microsoft. Go pull up a chart on Google. Pull up a chart on anything. We are in a buyer's strike across Wall Street on software.
Dan, I think this is the problem that you and a lot of very talented analysts have right now on many of these names, is that the story might make sense from a single name perspective, but they're all getting thrown into the same bucket. You've been looking for bifurcation in the sector. I'm trying to work out whether you see that in the numbers, one, and two, why you think the market's going to start telling that story, seeing that story in quite the same way anytime soon.
Well, first, I think the bifurcation you've seen in tech earnings this week. You look at cloud, strong, Microsoft. You look at what we saw from Qualcomm, even the cloud numbers coming from Google, from Amazon, and then, of course, Apple in terms of what we saw there, and even on the 5G play. The have-nots, okay, the e-commerce piece of Amazon, Netflix, and some others, and even Meta was better than expected. Look, I think it's a have and have not. I think it's enterprise, cloud, cyber, semis. That's what drives us higher, along with Apple. What drives, and ultimately the work from home, those could continue multiples to compress. Look, I think ultimately we are going through a situation where many are yelling fire in a crowded theater. Maximum fear. But I can just tell you, in 20 plus years covering tech stocks on the street, I view this as more the opportunities in the chaos rather than time to throw in the towel. And that's why I look at the fundamental stories relative to growth, which is why now I view this as more of a time to be bullish in terms of periods of panic.
Does that include Amazon?
Look, I think with Amazon, they ultimately just cleared the deck, massively cut numbers. The street will adjust, and then let's see where we are from 3 months. Because I think with Amazon, the big part of the re-rating story is cloud. And I think we're just in one of those periods where bad news is bad news, good news is bad news. And I think some of this is that's just a normalization from work from home. We're starting to see on the e-commerce side. But I do think overall, we sit here for tech earnings this week, massively better than feared. And overall, I think we're seeing a clear bifurcation of the tech sector.
1.3 trillion is the current market cap of Amazon. Brent Thill at Jefferies did a sum of the parts for us a little bit earlier. He said AWS alone was worth something close to 900 billion. How would you value that company, Dan? How would you go about doing that?
My view, similar to what Brent's talking about, I think when you, and I think what's starting to happen on Alphabet as well, on the GCP piece, because you're looking at the cloud transformation, I'll call it a fourth industrial revolution. That's why Microsoft's numbers were so strong, because they're really a pure play cloud name. Amazon, I think what gets lost in the noise last night is that AWS piece, that's really going to be on a run rate of, 80 billion plus in terms of where it's going. I think that's something where the street more and more is going to start on some of these valuations to do some of the parts, because I believe what's baked into some of these tech stocks is just, I'll call it category 5 hurricane headwinds.
The whole of the sell side agrees. I'm going through all these notes right now, Dan. This came from RBC. Inflation, underutilized readied capacity, and tough comps are something of a perfect storm, but are now also better baked into Wall Street models, making the setup from here positive. The stock's down 11%. I get you want to lean the other way here, but does the response of the market to these numbers, the numbers that you say are strong and still okay, Dan, is the response to these numbers tell you anything at all?
Well, I can tell you right now, it's just nerve-wracking talking to investors that I'm hearing inbound as I've seen in the last 6-7 years. Because right now, especially from an institutional perspective, you could be right on quarters. Stocks are not reacting as you'd expect. And I think anytime that happens, the dislocation, everything is getting sold here. But again, I keep going back to the enterprise, the cloud stories, the cyber piece, that continues to move forward. And I think even in Apple, we could talk about 4 to 8 billion. But ultimately, I think the headline is that the demand story for Apple is Teflon-like. And I think that's important. And I think it can easily get lost in noise. But we're in just one of those markets. There's going to be many, really yelling fire in a crowded theater.
China, is it really Teflon-like, Dan? Nomura in the last week are looking for a 3 handle on GDP in China. We know China's an important factor on both the supply side and the demand side for this company. Can you really call that Teflon-like demand, Dan, given the lockdowns taking place in that country?
I call it Teflon-like relative to expectations. If you look at China for Apple, you still have more than 50% of the customer base that have not upgraded to the next iPhone. And especially more and more going higher ASP. And it's relative to what's baked in here. I mean, China growth was called low single digits, streets baking in negative growth. If anything happens slightly positive relative to expectations in China, I think a lot of these tech stocks rip. And that's sort of our thoughts. Our thoughts are relative to how we're sort of setting up into the second half. And especially obviously with the Fed rate cycle now is sort of taken hold. I just believe a lot of these tech stocks, specifically names like Apple, Microsoft, among others, especially on the enterprise stores, I think these are way oversold.
Well, we're certainly in positive territory now on Apple, positive almost 0.1%. On Amazon, a very, very different story. Dan, wonderful to catch up with you over the last week. Been a good friend of this program, just guiding us through the stories. He's staying bullish. Dan Ives there of Wedbush. Apple's up by a couple of 0.1%. Amazon looks like this. It's down by 11 full percentage points. Coming up, Democrats facing inflationary headwinds ahead of midterms.
I think we're going to be in real trouble if we don't get up and deliver. Then I believe that Democrats are going to lose.
That conversation just around the corner with the National Economic Council Director, Brian Deese from New York. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes. Según las modelizaciones, nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
what's happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
The supply side remains an issue. We're also hearing something new, which is that corporations are starting to worry about the demand side. They're starting to worry about demand coming down. So if you think of it, we had a supply disruption, but demand is fine. They're telling us the supply disruption will continue, and keep an eye on demand because that's starting to weaken, which when you translate for the economy means stagflation.
That was Mohammed Al-Arian. For him, the outlook is problematic. Let's get you some breaking news. Just crossing a wire. Here's Taylor Riggs.
John, really interesting. Take a look at shares of Tesla. We overheard over the night, of course, that Elon Musk had sold about $4 billion of his stake to help maybe in part fund some of that purchase of Twitter. We are now hearing an additional $4.5 billion. So that brings the total for this week to $8.5 billion that he has offloaded, of course, to help fund the deal to buy Twitter. On average, according to that Form 4 filed with the SEC, about $902, $903 per share. But that brings a lot, about $8.5 billion now so far this week in selling from Mr. Musk.
That's a lot of money and a lot of selling. Taylor Riggs, thank you. That breaking news out just moments ago. Looking ahead, midterm elections just around the corner. Amid surging inflation and slowing growth, do things get worse and not better? Democrats falling out of favor in the polls. With more, here's AMH down in D.C. Morning, Anne-Marie.
Good morning, John. Inflation is definitely the key issue for the Democrats heading into the November elections. But just yesterday, we heard from the president's top Treasury chief, Treasury Secretary Janet Yellen, and she made no reference to inflation. And she defended the Biden administration's stimulus package, which obviously draws a lot of criticism from Republicans. They say that this is fueling inflation. The issue, Jonathan, is that at this moment, there's really two big items that are top of when you look at consumers' mind, and that is gasoline bills and grocery bills. And the Ukraine war has just exacerbated these problems that were already there. When it comes to gasoline, we've seen what the administration has done, which is, of course, the SPR release, the ethanol play this summer. Now what you're potentially going to see on the Hill, you have Senator Schumer and Speaker Pelosi talking about beefing up this authority for the FTC to go after companies. They say this is price gouging. At the same time, you have others saying maybe a gasoline tax holiday. There's very little at the moment they could do to try to quell these prices, and they only have a few months, Jonathan.
Anne-Marie, thank you. Let's talk about that now. This was the White House's response to the GDP print from yesterday. They said the following: while last quarter's growth estimate was affected by technical factors, the U.S. confronts the challenges of COVID-19 around the world, Putin's unprovoked invasion of Ukraine, and global inflation from a position of strength. Lucky this morning to have Brian Deese with us, the U.S. National Economic Council Director. He joins us now. Brian, first of all, thanks for giving us some of your precious time. Let's just start there. The optics aren't great. Q1 GDP negative, inflation 8.5%. How do you explain to the electorate right now that things aren't as bad as they feel like they are?
Well, we're in a moment where the economy has some significant strengths and some very significant challenges. As you just pointed out from last quarter's GDP print, what we saw was a continuation of strong consumer spending, business investment, residential investment, and we saw the technical factors associated with inventories, but even inventories building as businesses come back from the most acute supply shocks of last year. And at the same time, we face real challenges. The war in Ukraine is putting upward pressure on prices at a time where that's not what we need. And we have a challenge of price increases across the board that we need to tackle. So what you see from the president and this administration is waking up every day saying, how can we operate from this position of strength? The United States is uniquely well positioned among almost every major country in the world. What can we do to try to help address these issues? And our focus right now is on measures, practical measures that can lower costs and lower the deficit. That provides relief to families across America and also would help counter inflationary pressures as well.
Let's talk about that policy effort. Chevron this morning just announced the biggest profit in a decade. They expect to keep overall output either flat or down to 3% this year. Exxon just delivered a $30 billion share buyback. What's the policy response, Brian, to that?
Well, number one, we have said we need to see more production in the United States. The market provides every incentive that companies need to produce more, and we are encouraging companies to do so. As you noted earlier, we took the extraordinary effort, the president took the extraordinary action of releasing 1 million barrels a day from the Strategic Petroleum Reserve for 6 months. That is a bridge to a period later this year into Q3 where the industry themselves have said they intend to increase production by about 1 million barrels a day. We want to see that happen, and we're also taking steps to try to ensure that. For example, putting a fee on leases and leased areas where companies are not producing. If companies are going to hold a public asset and they're not going to use it, then they should pay more for that. Those are the kinds of things we're focused on the immediate term to try to get more supply onto the market, while at the same time being very focused on what we need to do for the long term. And what we need to do the long term is provide technology and neutral incentives to drive the entire economy toward cleaner energy.
Is there anything you can do on the tax side for the consumer, given where gas prices are?
Well, we're looking at all options. Everything is on the table. The goal of increasing supply, just to be very clear, is to provide relief to the end consumer, because we are supply constrained in the current oil market because of Russia's invasion and because of Russian barrels coming off the market. Bringing more supply online should help to bring prices down at the pump. That's in the immediate term. We've seen some relief from last month, but we want to see those prices come down further. There are other ideas out there. Congress is looking at them. We're engaged in that debate actively. Everything is on the table, and you've heard from this president as he went to make the ethanol announcement that you referenced a couple of weeks ago.
Yeah.
Wherever there's a practical tool, a sensible tool that will help provide some consumers relief, he's absolutely open to that.
Is student debt forgiveness a sensible tool?
Well, you've heard the president talk about this. We've got a significant challenge in the country of millions of Americans who are burdened by excess student debt, and it affects their decisions. It affects their life decisions, their economic decisions. And so it's certainly something that we are looking closely at as well. We have extended forbearance on student debt as we continue to face uncertainty of this economy. I'm not going to get ahead of the president. As you heard from him yesterday, it's something he's looking closely at, and you should anticipate we'll probably have more to say on that issue in the next couple of weeks.
I don't expect you to get ahead of the decision. I would like to understand what you're considering. What are you considering?
Well, as of for the last multiple quarters, we have had forbearance on student debt payments, which has been part of the policy response, including, for example, a moratorium on evictions and foreclosures, so that as we navigate through this very complicated economic period, we're trying to provide some relief to American families. As we look forward, the key policy questions revolve around actually forgiving or extinguishing some of that outstanding stock of debt and providing not just payment relief. So that's the issue that we're looking at and the parameters of that.
Controversial decision, if it has to be made, and we're going to talk about it a whole lot more in the future, I hope. Brian, fantastic to catch up with you, sir, this morning. Thank you for your time. Brian Deese there, the U.S. National Economic Council Director. From New York, coming up, we'll whip through the trading diary for you and whip through this price action too. What a week it has been on the S&P 500 and on the NASDAQ too for the month. The NASDAQ on the month is down around about 10%. We are heading for the biggest monthly decline on the NASDAQ 100, going all the way back to 2008. From New York, this is Bloomberg.
Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Five minutes into the session, equities trying to stage some kind of comeback. We're down 0.8% still on the S&P. On the Nasdaq, we're down 0.75%. 10% of the S&P 500. Two names, you know it well now. Amazon, Apple. Apple has made a comeback. It's positive 0.4%, in line with maybe the kind of things that something that Dan Ives has got to talk about over at Wedbush. Apple back to 164. Amazon is going nowhere higher fast, down by 12.6% in early trading. That's the price action. Here's your trading diary. The week ahead, the next 24 hours, US PMIs plus ISM manufacturers coming out on Monday, RBA rate decision and the Fed kicking off its two-day policy meeting on Tuesday, a Chairman Powell rate decision and news conference on Wednesday, followed by the Bank of England on Thursday, and finally, we round out a very busy week with a payrolls report. What a week we have coming up for you. From New York City, thank you for choosing Bloomberg TV. This was the Countdown to the Open. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to
Connection lost.
Their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard, In America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complications due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. and it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. he emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environments, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't. And the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact